Check 1, 2. What the fuck is going on out there? I just got demonetized. I was swearing. How are you all doing out there? Oh, baby, what's going on? Where's that fair value? That new contract is out. Whoa, that new futures contract. Fair value, baby. Got the MOC sell side over $1 billion. Working for the Bulls yesterday. Huge shout out to Trader Podcast on that one. Hell yeah. Oh boy, oh boy. Hold on 1 second here. Bam. Okay, what are we doing up here? Got a 30-minute chart up here, right? I'm going to show you a couple things that I want you to see. You've got this little bit of vol right in here. Breaking past it right now. Look at that near perfect bounce. Got this prior high back here as well to be looking at. See that prior high right over here. You got a little one right here, a little bit of vol. A little bit of vol up here too. We put it back on the 1 minute here. See, oh, look at that 1 minute chart right here. Look at how sexy that thing is. You got another little bar up here. I didn't post this on Twitter. I should have put this last little one right there. You might get a pullback right about now. Right about now, you should see a slight pullback here. And then you've got one more target to the upside. So let's take a look at that real quick. Put that right there for you just so you can see it right there. Does that help? Give me just 1 quick second here. Good morning to all of you out there. I'll be honest. I gotta be fucking honest. So yesterday, I was buying that close pretty heavily. As a matter of fact, I was buying the fucking bottom too. I was like, bam, 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 just adding and adding and adding and adding. And I'm gonna be 100% honest with you. 100 fucking percent. I was scared shitless all night long because there was one more, like, it was too easy to just do that. In my brain, I couldn't figure it out. I was like, I said something to you guys yesterday. I said, it's probably better for you to not trade puts into the close yesterday. I was like, yeah, we could see that like last dip down and then we'll come back up before the open. But even so, I was even scared. I was more scared that they would dump us down into that 41 or 45.15, and then that rip would start this morning. That manipulation downside move, like you put the pain on the bulls, and then you hit them one more time before you run it up. Today, let's say, right? So, I'm for just that reason alone. I'm not going to tell you that I took that trade into the close yesterday, and I felt the highest confidence in it. The safer trade into that close, in hindsight, was waiting to this morning, even if I missed the trade. So I want to be caution you on that yesterday as I was doing that, I was like, yeah, we could easily slam this down, hit 45.15. Anyone trying to buy that close, pain trades on, wake up, even if it bounces this morning, you'd see, you'd be ripping up all your one dates for today, and then they would start that run higher today. They didn't. So I guess I won that one. But, dude, I'll tell you what, I was not feeling it last night. I was pretty fucking nauseous about it. I'm not going to lie to you guys. It wasn't the best trade to take into the close. Statistically, it wasn't. I mean, there were reasons for why we went up. Trader Podcast explained some of that to me last night, but still, very commonly you get that last little fucking dip down and then you get the rip. So at any rate, we're coming up into some resistance right now. We've got a couple targets to the upside, and furthermore, with that same idea in mind, I had got asked this morning, do you expect any significant downside move? And I didn't want to explain it on Twitter because I didn't want to. I didn't want to. I didn't want to explain on Twitter because price matters, and how you like what feel like what's price matters if we get a roll next week. Where are we getting that roll from? Right. So if we can't crash this market right now, we got a pin above at 4,600, right? A magnet above to 4,600, so we can't crash the market. We're building a base here for the market in the gamma world. So if they are gonna, roll it down next week, where is it from? Are they rolling it down from the bottom yesterday, or are they rolling it down from up on high? So, and that will matter. So my posit here is the banks are fucking long into Friday, and they're going to get their money to the upside. You should be looking for one of those highs into the close this week for a gentle pullback into next week. Does that make sense? A lot of some people out there are expecting step down from the lows that we had, let's say at the close yesterday. I would be more looking for a high into today, right? Possibly even tomorrow, to throw something on, some kind of sprinkle on into the 15th. And I haven't talked about this. I think I might have mentioned it yesterday, but there's something else I want to talk to you about, which would be there might be. I mean, we got to talk about Jerome for next week because the dates might not be exact, but it would be hilarious if you get no rate increase, right? And you get the whiplash action in the rate decision, and then a pin, and they just torch you, even if it's going up, just torch you for an extra day or so. The move comes after, like a day or two later. Not guaranteed. Dealers can chase if too many people buy calls and buy the market with real money. Yeah, it can go up, and the dealers will chase that move all the way up. But I'm betting right now that they are already have a plan in place to crush your dreams on rate decision day. We're pricing in no rate increase, so just be careful. We'll talk about it today. Just be careful as we head into that Wednesday. Of that, it's not that we're not going there. It's that you might get crushed on the way there. You might not be positioned properly. They can slam it down before the rate decision and make you rebuy all that shit again, right? So we're gonna have to play this one really, really close to the chest heading into Wednesday. Good morning, by the way, to all of you out there. Give me one quick second. I got some work to do here in the background. I love all of you. Hope you're all doing well. Fucking great morning, by the way. Dude, I'm fucking making so much money. It's not even fucking funny. Like, I was in my office this morning screaming, and my whole family could hear me, and they were like, what the fuck is wrong with him? They could hear me across my home, like. If I win big, dude, fucking, I don't know. This holiday season's been outstanding trading. If you're a bull or a bear, this to me, this whole the past few weeks or so, it's been pretty standard, right? Like, sell for great money, buy for great money, sell for great money, buy for great money, sell for great money, buy for great money. It's been pretty fucking epic. So And any of you that know me have known that for a couple weeks I told you guys, I think it's 14 sessions ago or something like that. I warned all of you. I've warned all of you in FinTwit, right? We're going to ping pong, right? Ping pong, ping pong. And you're going to see bulls get pissed at those tops and bears get pissed at those bottoms. And they're going to scream the whole way as we do it. And we did it. We fucking did it. I fucking love it. That's what I did. I said something like that, Beartown Sheriff. It was almost those exact words. Oh boy, look at that. Okay, I gotta do some levels really quick. Oh, I didn't post anything, did I? Hold on here. Shoot. Hold on. Let me do the live stream stuff. Hang tight here. Okay, so I got something to tell you guys, all right? I don't know what you guys, I want to tell you guys something, okay? Gather around the fireplace over here. We got something to talk about, okay? Now, I want you to do me a solid too, if you can. Hold on a second here. All right. Hang tight 1 second. Okay, so the stream link is out there. This is what I want to tell you guys, okay? I can't tell you a lot, but I'm gonna leak something small. It's not quite an ARG, but remember we talked about an ARG, okay? We are launching, okay? We are launching this week, okay? You are going to see some teasers come out over today and tomorrow into Friday, okay? What day is today? I don't even know what fucking day today is. You're going to see stuff on social media, and it's going to be throwing out some deals. So if you now I want to talk to you guys about two things. Let's get something out of the way here. So remember something here, gang. Do not ever forget your rules, right? We back check the 1 minute, right? Watch the line is still quite vertical. If it begins to flatten, we'll check the 5 minute, right? Stay soberish here in your trading. Remember yesterday in that close, right? People were bared the fuck up, right? And I was trying to be as calm and rational in my trading as I possibly could, even in the face of all that fucking doom on that close. So I want you as a trader right now to just remember your tools, remember your training that we give you here, and you trade this up as we do, right? Back checks, 1 minute back checks, 5 minute back checks. We know where resistance is on the upside. We know where last support is, right? So just be careful of that. Now, back to what we were talking about there, okay? I want to say a few things here. I want you guys to know that what we started here was for retailers. The entire thesis began because I was on social media and I was tired of seeing my friends. I don't care if they're bulls, bears, theta. I don't care. My actual friends on social media getting fucking torched, like blown up, just like gone, money gone, and drinking Kool-Aid, bull Kool-Aid, bear Kool-Aid. I don't care, whatever. And the one thing that bothered me that I felt was that if most people had just some fucking dumbed down simple tools, they would dumb down simple tools in their toolbox that they could become a somewhat better trader. And I didn't know nothing about streaming. I had no vision, no nothing. The only thing that I had was I'm gonna stream for my friends. And so we started this thing with 100 people, 200 people, I think, something like that. And all those people are still here today, majority. I'd say like 80, 90% are still hanging around here or on Twitter or even old friends from Wall Street Bets from back in the day. And this has been hard work. It has not been easy. It's been a labor of love. It's cost me a lot of money, cost me a lot of time. You guys have seen me get torched in the stream, right? You guys have seen me lose a lot of money in the stream. You guys have seen me have heartache in the stream. Um, it's been brutal, and there's been a lot of people come along with us along the way that have had that same experience. Admins, moderators, developers, supporters. People support me on. You'll see people come after me online, and people defend me. Right? They don't want to have to defend me online, and they do. So, I didn't think it would grow or become what it is today, and so for that, I'm very grateful to you. And I always made you a promise that what we do here will always be free, and it will always be free. I promise you that. Now, there is a group of people here, okay, that want this to stay what we're doing, right? They want this to continue. They want it to grow. They want it to grow into something more than what it is. They're willing to support what we're doing if we offer more. So, as you know me, that will never change. Our relationship, that agreement that we made, will always be there forever and ever. And I will never be a part of this if that ever goes away. But there are people that want more, and there are people that are willing to pay for that. They literally contact me and say, do a website, do tools, do this, do that, so that I can get my own access to it, and I'll pay for it. So I just want you to know that as we move forward. Because I was in a meeting last night, and I was like, there's going to be some blowback. There's always voices out there. It's like, that guy's a fucking sellout. That guy's trying to make money, all this other stuff. I want you to be aware that in the background, the guys that I work with to make this final product that you see out there every day, that is not our intent. None of our meetings are based around that. Our meetings are based around making this last, right? Making sure that we can bring other people in to make this last, to always be there for you guys, and to do more development to offer you even more. And so there are people, supporters out there that want to see that happen. And we're going to launch that next phase of what we're doing here, okay? And so because I've known you guys the longest, right? You and the guys in the Discord and all that, the guys on Twitter and stuff like that, I want you to know that you're going to start to see some like an ARG type thing come out in the next day or two, right? For some discounts and deals and all that kind of stuff for a launch that's sooner than you think. We're talking like real soon. Like, I'm not going to tell you anything else other than that. So what I'd say to you is, if you know people that I know, my friends, right, you might see them posting stuff with breadcrumbs as to where to look and where to go and what to do and all this stuff before it happens. You'll see guys like Joe Donut. You'll see guys like Raveology or John L. or David AMS or Binky, Chaz, all these guys that you guys know who I know out there, right? You guys know who my boys are, my friends. If you start to see any of that stuff, just read on it. And when it pops, we're going to do it together as a group, okay? So I'm looking forward to this. This is, if you've been here since day one, please, like this next few days, time to have some fun for a few days. Smile, enjoy, look back, and be grateful. And we got some from this launch. We have a bunch of other tools that are coming out as well, dropping in upcoming weeks and months and stuff like that. It's gonna get really fucking cool. So stick around, hang out. If you don't want that stuff, you'll always have that option to not have that stuff. They'll always have a free option for you. So don't feel like you're gonna get left behind, or I'm gonna sell out from you, or you're not, I'm going to do something differently than what you've experienced here. There's one small thing that I have to talk to you guys about. There's one small thing that I can't continue with. And there's going to be some changes to the Discord. I'll go into that later, what those changes are, but we have one fucking problem, and that is we have a financial Discord, right? We're not a gaming Discord. We're not a gaming Discord. Like if we had a gaming Discord and I was 12 years old, I buy a game and then I don't spend any money. I might spend some money, right? I might go out and get upgrades and stuff like that for $10 or $20, something like that. But because we're a finance Discord, we attract scammers, we attract bots, all kinds of insane shit that the admins deal with in the background, and it's wild. You'd be shocked at the amount of work we do every single day to try to thwart that. So there's one thing that will change slightly. It'll be very much like the chat on YouTube and Twitch. It's to deter scammers and scammers, bots, and all that kind of stuff. And it's for the safety of our community that we have to do that at some point in the coming days. So that would be the only change that I see that might be detrimental or piss someone off or something like that. But other than that, we will always remain true to that original promise that we made to you as a community. And I want all of you to know that I fucking love every last one of you guys. I love all of you, women, men. I don't care what you call yourself. He, she, them, whatever politics. I don't care what your politics are. I want to express my gratitude to all of you for getting together as a group of retail traders and focusing on why we're here. So I really appreciate that. You guys have been fucking awesome. Best trading group in my view on the entire fucking internet. You guys are, I want you guys to know one last thing. When I was, for a lot of years, I didn't see young people learning a lot about the indexes. It's like you get stuck in memes, you get stuck in Tesla or Apple or whatever your favorite thing is, AMD or whatever, NVIDIA. You guys are spending time learning about the indexes with me, right? And this is going to be a fucking tool for you to make money for the rest of your career in this market. You can go off and chase Teslas and GMEs and all that stuff, but you having that part of your toolbox that knows that you can always go back to an index and make a living from it fucking warms my heart. I kid you not. Like, it makes me want to cry right now at this moment that hold on a second. Makes me want to cry because like any young trader out there right now, right? You guys are getting something that it's going to change your life. You're going to look back at 5, 10 years, 20 years, something like that and be like, I got that fucking tool. And I can trade that fucking index. And come in any day of the fucking week and trade that fucking thing. There's liquidity there. There's a community of old people on FinTwit. Old traders, floor traders, guys like Jem out there, right? You get guys like that out there that are passing all that shit down to us. And warms my heart knowing that there's going to be a whole nother fucking generation of index traders for another 10 years, 20 years, you know? We get like 130,000 unique views on the show every month. You're talking about impacting like just so many retailers, like so sick. It's bad as fuck, dude. You guys are want you to know if you're watching this, you guys are the baddest motherfuckers out there in my view. Period. Baddest motherfuckers on the planet. You guys are the whole next generation. You guys are going to be around here 5, 10 years from now. You guys are going to be the gems out there, the gem croissants. You guys are going to be the, like the Jedi Marcuses and guys like that. All right, enough of me. I'm going to be quiet for a minute. I got to get control of myself. But I love all of you guys. All right. Give me a second here. I love all you guys out there. I just saw your chat. I love all you guys out there. I say, Momo, I watched Chewy, baby. What did I tell you about Chewy, brother? What did I say, Chewy? What did I tell you about? I saw that Chewy. I looked at it last night, doggy. I saw it swing right down there and slap it, didn't it? Momo Land, I checked, brother. I was looking last night, man. I followed up on you last night, brother. I saw Chewy last night. I paid attention after close. I watched that, my man. Love you, Mr. Talking Monkey. Fuck yeah, I love all you guys out there. All right. What are we doing here? What do we know about where we are in the structure right now? What do we know? If you had no other tools on you right now, you had nothing, right? What would you know about this, right? We back checked the 1 minute trigger, back checked the 5 minute trigger. On a successful retest, what are we looking for? Let's get rid of all these. Let's get rid of all this shit right here. What are we looking for here, right? We're looking for previous highs, right? We got a pivot point right here. Hold on a second here. What do we got right here? Got all the sellers right here, right? What do we got right there? Some more sellers up here, right? Now, that's intraday. That's intraday, right? That's on a weekly basis too, right? So let's look at the week. We got some other highs up here, don't we? Get all that shit back here, don't we? Don't forget that little one up there. Forget that bad boy up there. Right? You got this one right here, right? Got that little bad boy back here. But what do you have on the 1 minute chart? You have this little guy right here, don't you? So forget about all that shit up there for right now. We don't care. We don't care about this. We don't care about that. We don't care about any of that stuff. What do we care about? Care about this little guy right here, right? This little pivot point. And what's our previous pivot point? Right down here, right? We got this little one right here. This is all you're concerned with, right? Right there. And this one right here, right? That's it. That's all you care about. You know that you have only a few minutes, right? 15-minute intervals we talk about, right? To break above and catch a new high, even if it's just a tick. Even if it comes back down, it's telling you, hey, we're bullish and we're going to make that next pivot, right? If we don't have this, so we watch, right? We're sitting here watching. We're just watching right now, right? You want to see that previous high get taken out to get bullish again, right? To give you the chance to make that next target above, right? The next pivot, right? If it doesn't happen, what are we looking for? The next pivot down, right? If we fail to make the new high right here, it shows weakness on the 1 minute trigger, right? Not necessarily bearish, just the 1 minute trigger. That's it. So what would happen if we failed that? We would come back down and check the 5 minute trigger, right? Boop, boop, boop. Come back down here, check the 5 minute trigger. Is that bearish? No, right? It's not bearish, is it? We're just checking it. Come back up here, right? If we come back up and touch that right there, we're bullish, aren't we? We were just doing a back check on a 5 minute. Come back down here, and then you can take that. You're like, hell yeah, right? I can go up here. Now, let's say we go up there and we fail right here, right? What does that tell you? Well, we're not bearish, but we could consolidate down here for a little while, get caught in the finger trap, right? Let's say we come down here and we catch that bounce and it's very weak, right? We start bouncing down back in here. What is that telling you? It's telling you that we're going to start to get bearish, right? Expect that roll over here, right? And even if you blast down through here, you know you're still going to be given a chance to get out before the big roll down comes, right? You can do this on every time frame. You can do this on a 5 minute, a 1 minute, an hour, a day, a week, a month, a quarter. Very simple stuff. Very easy ways to figure out. If we blasted down, did you need to catch all of this here? No, you need to watch this to get bearish. Your percentage of win gets higher the more that you be patient, sit on your hands, and watch the structure. Same thing on the upside. Patience on the upside. You pull back, check the 1 minute. You wait for it to construct a bullish thesis to the upside, a neutral trade sideways, or then a bearish trade, and your win percentages go up if you wait and tag that one, or even this in reverse to the upside, wait to tag it to the upside to get that squeeze. Timing matters. Execution matters. It's not good enough. It isn't. It is not good enough that you called it. You need to have the tools in place so that you can take only the choicest trades, that you set them up with your tools and say, okay, we did this, we did that, we did this. And then you put your risk on. You know where your stops are. You know where, if it goes against you, when to get out. And you manage your risk. You're not going to win every one of them, but you want to be winning 7 of them, 9 of them. That's your goal. You don't want to be listening to people out there tell you you only need to win 3 or 6. They don't know what the fuck they're talking about. After the taxes, after the fees, if you're only winning 3 trades, and then you have one huge blow up, or you get greedy, you do something, you blow up your account, you should be a fucking tactful tactician. Like you are like a surgeon. Patience. Be a surgeon. Follow your rules at all times. Security's the trap. Thank you for joining us. I love you, man. Just said, learned so much from your gifts. Been trading with you for over a year. Thank you. A man is an emotional creature. Let it rip, brother. You're family. You're my family too. Security's the trap. All right, let's see what happens here. Let's watch this unfold. Now, we can look other places too, right? So you got this tool here. What else do you have? You can start to check HYG, start to check the VIX, right? You can check other indexes. You can check XLF and see how strong it is. You can check sectors. Is utilities ramping right now? Right? Are we rotating in utilities? Are we rotating out of big tech, the Mag 7? Are we rotating back into Mag 7? Are we rotating into the small caps? You can have a screener up at home and just have what? You can split a Webull chart. I think you can split like 12 times. If you're too poor to own a second screen at home, go down to a Salvation Army and buy one. They're $5. Get a USB to HDMI, stick that in your computer. Now you got 2 screens. It doesn't have to look pretty or set up at home. You get a shitty setup. As long as you got 2-3 screeners over there at home, you start watching other sectors. You can watch the 10-year. You can watch TNX. You can watch DLT, gold. Put together another picture as this happens and say to yourself, is this the top? While this here unfolds, I'm going to go check out, take a walk around the market, I used to call it in the stream, right? Let's take a walk around the market and check out what's going on. What are the mechanics going on the back end of this market? All right. I got another issue for you guys this morning. I have 3 big meetings today to launch this morning. I got to get together with John L. I got to get together, or you guys, Morpheus. I got to get together with Morpheus. I have to get together with Binky. I have to get together with Joe Donut. We've got 3 huge meetings to finalize a bunch of stuff. I got to run my credit card like 10 times and make sure that nobody gets fucked in this process. We don't break something. And I've got an army of people that are going to be manning email terminals and all kinds of other stuff to make sure we make this as smooth as possible. In the next couple days, I'm like very anxious. I'm very anxiety ridden right now. So I have to work in the background here this morning. I will be here with you. If you don't understand what I've told you so far about the mechanics of a trade, we have trusted people in our chat, in our stream. Matter of fact, I'm going to turn the chat on for everybody right now. We turn the chat on because I'm not going to be here. So hold on one second here. I'm here, but I'm only going to stop in on big moves. Like we did yesterday at the close, right? And the people that stuck around yesterday in that close, I came on the stream yesterday at 4 o'clock, right? 3:45, something like that. That last hammer down, I'm like, yeah, I'm buying this shit. So I will be here with you, but I have to jump on some meetings. So here, I'm gonna make sure that everybody can chat today. So you just need to be a subscriber for 1 minute. Okay, it's free. Just on YouTube, just click subscribe, and you're a follower. You can chat. On Twitch, same thing. It's only because I'm not going to be here, and I've got shot callers here that don't pay, but they're watching the show every day, and they're longtime followers, and I want to make sure these shot callers are able to be in the stream for you guys this morning. The chat is now open for everybody this morning. How are you all doing out there? Hope you're all doing well. If you're watching the show at home in your office somewhere, if you're in an office, if you're in a hedge fund out in Europe, good morning. You're in a hedge fund in Japan, good morning. You're in a hedge fund in New York or some strip mall in middle America, good fucking morning to you too. Yeah, the subscriber is free. You just click subscribe. It's not member, it's just subscriber. It's like all you do is click subscribe, and you should be able to chat within a minute. They make you wait a minute or some shit like that. Let me check YouTube really quick. Make sure I got this right. Hang tight here. Hold on here. Okay, so now anybody can chat right away on YouTube. I set it to 1 minute. It's now, anyway, you just click subscribe and you can start blowing it up. You want to watch that price action? You guys already know what this price action is, right? You guys are price action traders, momentum traders. That's what you guys are. You guys are Momo traders. Up and down, up and down, up and down Momo traders, up and down price action traders. Price is king. Should be a t-shirt that you wear. Price is king. Hey, GG, what up? To the point. What up, brother? Morning, Angelus. Angelus. I love that fucking name. It's a good name. If that's like a play on Los Angeles, right on. I was an LA boy for a little while. Spent a couple of years living in LA. Lived in Santa Monica, right on 9th in Michigan. I lived right by the beach. It wasn't actually 9 streets either. It's only 6 streets, I think, on 9th Street to the beach. I think. I could be wrong on that, but I think there's only 6 streets. But I lived right by the sandwich shop over there. We get the Godmother. Bay City Delis. Lived like a block away. Good morning, Michael. How are you? Chris Knight, what up, brother? Mission Possible 777, what's going on? Hell yeah, Nino. Who just donated $69? Who the fuck did that? Stay humble. I love you, brother. Oh, dude, is that Stepping Stone Trader? Is that Stepping Stone Trader? If that's Stepping Stone Trader out there, what up, my man? Stepping Stone Trader, if that's you, man, you're like, you and I were like, what, like just you and I on Twitter, right? At one point. If that's you, I love you, man. Doesn't macro matter at all? Yes. Matter of fact, I was talking to Binky about macro. We were discussing macro yesterday and front running too, and how people have a lot of stuff wrong right now. Front running. We're discussing small caps, and some people were like doom and gloom for small caps, and I was like, you know, if you go back to when we began the rate cycle, there were bears that said sell mid and small caps. Rate cycle starting. And I was like, fuck yeah, that's what you do, right? We're all in agreement on this, right? You're in agreement, I'm in agreement, you're in agreement, right? And potential ending to a rate cycle. Hasn't confirmed yet, but potential ending, right? And we're hearing people out there still say short all that shit. And I'm like, that's some forward-looking shit. So we're talking about that. Does macro matter? Fuck yeah, it matters. But oftentimes people get it wrong. Its impact on the market. Where should it go, right? Good news, bad news, good news, bad news is bad news. When is bad news, all that kind of stuff. A lot of that has a lot of overlap in the front running and pricing in of that stuff. Right? So what ends up happening, right, is they come back to you and they say, oh, the rate hike cycle's done, you should buy small caps. But they ran it up 6 months before. You know what I'm saying? They dump into you, right? They sell into you. It's too late. So you have to be one step ahead at all times. Even if it doesn't go, that's the other thing. Even if it doesn't go that way, so they'll front run a move before it happens. And even if it doesn't happen, they'll then just pull the plug on it. Does that make sense? They're not, they beat you. Banks beat you. They're ahead of you every step of the way on every time frame. Good morning, Johnny Haggerty. What's up, my brother? Oh, do not become a member. Listen to me closely. Do not sign up to become a member today, please. Like, don't be signing up to YouTube or Twitch or any of that shit. Stop signing up. Just give it a day or two, okay? Just chill. Chill, daddy. Chill. Just chill for a day or two. Don't be signing up for like the $5 memberships, any of that shit. Don't sign up for that stuff, please. For a day, just hang out for a day or two. Just hang out. Just chill. So Ryan Vargas said, thanks, but the U.S. markets have been too stretched by nearly 12% without an even 1% correction. That doesn't seem healthy, right? Seasonally, from a seasonal standpoint, you're shorting the wrong time of the year. If we were in February or April and the market was going up, I would agree with you. Not this time of year. This is a market function that takes place at the end of every year. So we got some tax loss harvesting going on. We've got pump up your tickers that have produced to max them out. We have tickers out there that have not produced but haven't gone down to the depths of hell either. So we're going to rip those ones up at the end of the year. There's a lot of mechanics going on in the market right now that's end of a year function of end of year. We also have some other issues here too. We've got some gamma issues for bears. One of them being that we're creating a gamma floor and we're expanding the call walls to the upside. And we've got this stupid fucking pin on 4,600, and it's a magnet right now. Then we've got the JPM collar working on the end of the year. There's a lot of moving parts right now that are going to infuriate a lot of people. I posted about this, and I harped on it, and people didn't want to listen. And I was like, okay, fuck it. That's what it is. So it's not like this isn't hindsight trading here. This is, you told you before, and it worked out just like this. It's a function of market mechanics. Everyone knows that or not everyone, smart people know what's going on. And a lot of us are like scratching our heads, right? Why don't I understand what's going on in the market right now, the function of the market here? What up, Arthur Lopez? Yeah, that oil yesterday, Johnny. I was looking at CL yesterday, and I was like, woo-wee. Got to buy that oil down there. All right. All right, I got to go. I got to get, these guys are going to be pissed at me if I don't go. These guys are going to be angry. Right on, Ryan. Yeah, man, there's a pin right now in the market. Anyone out there telling you we're topping? Out of their fucking minds. They don't know what they're talking about. Anyone out there telling you we're going to fucking 480 like today? Out of their fucking minds. They don't know what they're talking about. There's a market pin here. Now we can unclench a little bit into next week. There's a high probability, and into the 15th. We have another gamma bar that's hidden. Of this giant gamma bar that we have for the end of the quarter, that's like a magnet. We have some weakness coming into the markets right now, unless something changes, for the 15th. As soon as that bar goes away, right, into the 15th, there's a little bit of an unclench coming. Now, the expected downside from that will be price dependent. So it would not shock me to see us run up, right? So once that gamma starts to have less of an effect on the 15th, you could see that market pull down and back into Wednesday of next week. Now, we do have, of course, some pretty big fucking vol on Jerome Powell and his decision on I believe it's Wednesday, right? So we'll pay attention to that volatility, and I'll be honest with you guys. I want to short the fuck out of that shit. So I think it's a weird thing. It's a weird thing. Dealers might have to chase upside, but if they don't, this is a great trap for bulls. So I don't know. The only thing I can tell you is I hate saying this because it's not my word. This comes from Brent and all those guys. There's a window of weakness coming up into the 15th. I'll say that, okay? Does it mean we're going down? No. But there's a possibility. There's a window for you to possibly have a pretty big fucking short. But where price is will matter when you time that short, right? You can be right all day long, but if you're fucking short in 460, you're not short in 452 from yesterday, right? So price will matter on that trade. You have to be Johnny on the spot on that trade. Okay, I will be back with you guys. I'm gonna turn on the news squawker here for you. Look at that natural gas, baby. Woo wee. Natty gas. The Widowmaker. All right. Hold on. Okay, so I got them on. I'm gonna turn on some CNBC in the background for you too. See if we can get some CNBC going. You know what? Before we turn CNBC on, I'm going to talk to you guys, okay? I'm going to give you guys, before I leave, I'm going to give you guys at least an update here. I'm going to talk to you guys about some stuff. Oh, dude. I'm not going to read this to you because these guys have been wrong all fucking week. They've been chasing being right all week long. But I love to see it. Okay, so I want you guys to know that 45.15 is still the floor. Remember that. Get your pens and papers out at home and write this stuff down, okay? 45.15 is the market floor. Bears need to get underneath it. If they get underneath it, they're going to make some money. If you want to know what I mean by if you guys want to know what I mean by a magnet, right? It's right there. And it grows every day. It was like here, now it's 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 here, and now it's here. It's just getting stupid now. So this is why we're not going down. If you want to know why, it's because of that fucking thing right there. Okay? That gamma bar right there. Part of this gamma bar expires on the 15th. That's 4,600, okay? So you have that information. Hang tight 1 second here. I'm going to read this to you. The narrative du jour is still well and alive. Winners, momentum stocks, get monetized while underdeveloped pockets are getting bid. The striking feature of today's session was the rally at long-end T-notes that ignored the substantial supply overhang while oil was getting hammered. Sub $70. Despite OPEC cutting production, very clearly the market is aggressively pricing in a soft landing scenario. Nomura's McElliott made a good point today, saying that the conditions simply aren't there yet for any sort of equities crash risk because we just aren't seeing funds long enough in the market yet. It's only when funds are brick long that this forces them into a position where hedges are required, which then puts dealers into a short gamma, short vega position in a spot down market. Only then can the games begin. This is illustrated by the put-call open interest ratio, which dropped by 35 BPS recently. Tomorrow's markets will receive initial claims before NFP print on Friday. Hopefully, we'll shake things up a bit. Nope. Didn't happen. Right? And I want to tell you guys something else. If you had the time to read the book that I've been pushing to you all year long that got pushed to me from Jedi Marcus, that was the Hedge Fund Market Wizards book, right? You know that the last asshole in the room is an elephant. It is banks. Banks are always the last to join the party, and they're not going to tell you that. And what they're going to do is they're like late bull run participants. You have these early risk-on, very risky, small, tiny hedge funds, usually kick-ass traders, big banks. They're the early guys. They come in very early, and they're the market makers. Actual market makers, too, come in and do this as well. They're scooping up the shit that you don't want, unless they're committing fraud, and then they ramp all this up. We have this big bull run, and then the last guy to come in is an elephant. And that elephant is usually like JPM, GS, those kind of banks. They come in with heavy risk, and they start loading the fuck up. So that's what they're doing quietly in the background. I'm also going to show you this here, okay? I want to show you guys the momentum risk ratio. Hold on here. I'm going to post it on FinTwit, okay? So I posted that on FinTwit for you. Put that up there for you. Tomorrow we have the U.S. U.S. employment report. We've got the U.S. unemployment rate. We've got U.S. hourly wages year over year, and consumer sentiment. Next week, we have no news on Monday. On Tuesday, we have Consumer Price Index, core CPI, CPI year over year, core CPI year over year. We have the monthly U.S. federal budget on Tuesday. On Wednesday, we get the PPI. We get core PPI year over year. Then we get the big boy. That is the FOMC interest rate decision at 2 p.m. At 2:30, you get a presser from Jerome Powell. That's Wednesday. Big day next week. If you're a bull and you possibly think that you're going to see the move after, right? You see the move after and not during, right? You can see a repressed move on Wednesday. You're looking on Thursday of next week for the initial claims, job claims, the import price index, U.S. retail sales is a big one. Then we get the Philly Fed survey. And on Friday, we got the Empire State Manufacturing Survey, industrial production and capacity and utilization. So Thursday could be a big trigger for next week. A little bit of blood here. No trade for me right now. If I see anything, I'll buy it with you. Okay. So what else we got here? I think that's all I got for you here in news. Got all. Oh, shoot. Hold on one second here. I got to do something else. I missed one more thing for you today. Hold on one second here. What am I looking for? What am I looking for here? Right there. Okay. R1. That's R1 right there. R2 is 460.50. R2 is right there, 460.50. And then 462, woof. Look at that range expansion. 462.16. That's your R3 right there.
AM Eastern Time, the U.S. sells $80 billion in 4-week bills.
Yes, pivot point today is where? 45.97. Yep, that's right where it's supposed to be. That's your pivot. And then we've got pivot points where S1 is where? Right there. Look at that range expansion. Woof. Look where S2 is, way down here. 448.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign
57.
Up today and get our
way down there. Nice, gorgeous range expansion today on SPY. Big moves expected on SPY. Big moves expected on SPY. There's your R2. There's your R3. Right there. Put that right there for you. If you guys want to snapshot this at home, you can. You guys want to see this on your way home right there? There's here, let me see if I can make this a 5-minute chart. There's your negative gamma down there. So you can see it right here. Series of lower highs. You got a lower high here, lower high here, lower high here, right there. And a little bit of a, I don't know, a traditional chart to say that's a bull flag. Bear's going to tell you, keep going down into next week. I like that trade personally. I like the idea of I love the idea of going down and then you get that huge explosive move to the upside. But I don't think it really starts until next week. Matter of fact, we'll show that to you right now. Give me a second here. So someone was asking me, where do we sell earlier? Or where does the roll come? Or we should be crashing? Or we should have doom and gloom and all that kind of crap. So we're going to talk about that right now. Seasonality. Boom. It's been a pretty normal year, right? We haven't had a big crash year, so we're going to expect to be pretty close to this year. There'll be some outsized moves, but on a larger time frame, it seems to be following pretty closely, right? So, do you see this big drop right here? See that right there, right? And this is the called it the 239th session. We got 237 down here, 241. So, let me see if I got that right. 240th session, somewhere in there. So, if you're a bear and you're looking for that roll, sometime into the end of Friday, you want to be divesting yourself of small caps. You want to be divesting yourself of large caps, or at least hedging yourself for some kind of a pullback into that trading, that day of that trading session of the year. Let's look at seasonality for NDX. See that right there, right? Nice move down. It's been following almost exactly, right? Look at the Mag 7, right? Right in there. Right, look at that. Almost exactly down here. And you're going to be looking for that dip buy down into the 243rd or whatever. So if you're going to get a true holiday rally, should be starting near the end of the year, traditionally. Now, I know this year is special because we got a rate decision, but just remember that if you do get that holiday rally, it's end of year. Also remember, if we get no rate increase, you should see an outperformance. See how on tech we get no?
$1 billion in 4-week bills, prior high yield of 5.29%, and a prior bid cover of 2.75.
I want to show you this right here. See the underperformance from tech in the beginning of the year, right? Now, I don't have the seasonality chart in front of me for IWM, but I have posted it on FinTwit. You should see an outperformance from IWM. IWM for January should look like this, or even like this, into March, if we don't get a rate hike this cycle. You'd see the outperformance. SPX, you get the outperformance. Nope. It's okay. It's good. You get that Santa rally or whatever you want to call it, holiday rally, into the beginning of the year. It's not outperformance, though, so it should be good, but it shouldn't be outperform. So what can we glean from all of this? If we roll into the rate decision and you do not see Jerome Powell raise rates, and you had to make a decision of what you were going to long into March, you're going to sit there with your hand on the buy button. You don't have to slam it immediately, but if you hear him say anything like no rate increase, but he warns you that he's going to rate increase in 3 months, he's lying. Historically, if we do not get a rate increase in this decision, he's lying. And even if he does raise again, it won't matter. I'm going to tell you why it won't matter. The market will, in turn, will not believe him, and they will ramp the fuck out of small caps, likely into March 31st. So you have your buy hammer ready to rock on Wednesday's decision. You get what I'm saying? Now, if he does raise rates on Tuesday, even 25 BPS, you could see an initial bearish reaction in the markets. I would expect no outperformance by small caps. You will likely see weakness in the market, but you'll get a Christmas Santa rally, holiday rally. It just won't outperform. If you get a 25 BPS rate increase, the only reason he's doing it is to give himself an extension from the market pricing in no more rate hikes. Okay? So if you see 25 BPS, he might do that just to buy himself time from what will likely trigger the markets moving in this anticipation of rate cuts into the end of 2024. We've gone over that ad nauseum at this point, so you be prepared for that as we head into that Jerome Powell presser next week. So if you're looking for a Santa rally, right, you'll get underperformance heading into next week for the new year. If you get a rate pause, you're going to see outperformance by IWM. And what else do I have to say to you? I don't know. I think that's it. I'm going to tell you secretly, I think we're getting 25 BPS. But if he does that, he's likely sealed the deal on a recession. So you'd then short oil and shit like that. You'd be taking like oil down to fucking $62. The world would panic over that. So I guess that's the only thing I can think of why he would raise 25 BPS would be to give himself about 5 or 6 months of time before he has to make another decision. If he did give you 25 BPS, also I would not expect another rate increase for 5 months. He will stretch that fucker out as long as he possibly can. Yeah, FinTwit is a group of traders, a group of badass motherfuckers that hang out on Twitter. FinTwit's a group of traders. Those guys go all the way back to like the old message boards when the internet was first invented. Old school, bunch of old fucks that have been around, slumming around for decades. Yeah, we watch this shit, right? We watch the unemployment's just creeping up. We know that it's gonna hit like 6% in December, right? You know they're gonna panic, start cutting fucking rates, right? You know you're gonna get a bounce down on inflation, a fake ass bounce, right? Inflation's, you guys know what the mechanics of this is. I'll tell you what the mechanics are. Fucking employment's gonna ramp up into December of 2024. Okay, you're gonna see inflation. Bullshit scam inflation print of the 2%, 2.1, 2.2. As we ramp up into that 6%, you're going to see wages increase. They're going to declare victory, but it's a fake. Your prices aren't coming down. Your wages are going to increase, and we're gonna carry on as we always have since 1978-ish. That's what's going to happen. Whether you like that or not, whether you agree with that or not, it's going to be the fraud continues until until the fraud becomes public, right? Until that happens, they're right now trying to manufacture. They say they haven't never done this before. I tend to somewhat agree with this, but it's still the same fucking scam. Trade the market sideways, buy time. You accept fucking Five Guys burgers being fucking $30 meal. They slowly try to pay you more money over time. A lot of workers, they won't. They'll try to squeeze them, keep a bunch of money, be as max profitable as possible. So something like that, some kind of like that scenario looks like what's playing out. And we've been talking about that fucking scenario for goddamn 2 years around here, haven't we? Talking about that scenario for 2-3 years around here. It's going that way right now.
High yield 5 spot 285%, 5 spot 285% with bids to cover of 3 spot to 0.8, 3 spot
It's looking
0.8.
juicy here.
So the
You guys
US
don't see this
selling
being juicy here?
$80
It
billion
looks juicy
of
as fuck
4-week
to me.
bills and awards 4 spot 24% of bids at high.
It's a nice looking dip buy right here. You got half-hour trigger crossing the hourly trigger. You've got a back test of the 5 and the hour going on right now. Get out of the way. Okay, so I got to go to these meetings. I'll be back with you guys. Say any major shift changes, anything like that, any kind of paranoia. That remember, this today is different than yesterday, right? We were trying to fight up into the hourly trigger, right? As the hourly trigger was coming down, hourly trigger is going up right now, right? It's going up right now. We're coming back to back check it. Your thesis is with the Bulls right now, not with the Bears. Makes sense? Yesterday was different, right? Remember yesterday I was like, don't be buying this here. It's very, well, not don't, but you can trade this, but it's very dangerous here. This is where the sellers are. This is not where the sellers are. This is where the buyers are. This is the inverse of yesterday. All right, I'll see you guys soon. Leave that right there for you. Paul's deep in calls. All right, I'll talk to you guys soon.
The top of the market right now. Walgreens at the top of the market. Both of those have been big laggards this year.
Yeah, it's been a theme for a couple of weeks, although as Bob says today, the indexes are moving on the big names. But yeah, there's you figure the tax loss selling is done and people can wade back in.
That and Alphabet and AMD having a little AI run right now. Let's turn to China. Mixed trade data coming in overnight. Despite a surprise beat for exports, imports fell. Missing estimates as China's economy slows. The lower growth prompting Moody's earlier this week to downgrade the country's A1 debt rating to negative. Our next guest is looking at foreign flows to the U.S. Treasuries as an indicator, noting that China's holdings of U.S. bonds has dropped $300 billion since 2021. And as the world's second biggest economy falters, demand will likely remain weak. Joining us now, Apollo Global Management's chief economist, Torsten Slok. This has been going on now for a while, Torsten, where China has been unloading treasuries. You expect the trend to continue?
Yeah, so the backdrop is exactly as you're saying, that Chinese exports have been slowing down. And why have exports been slowing down? Well, partly because the US has been slowing down and Europe has been slowing down. So if your exports slow down, that also means that China has fewer dollars to recycle into treasuries. So if China has less exports, that also means that they therefore get less dollars in their hands to recycle it back into global markets. And that does mean, therefore, to, as you just showed in the chart, to that point, that there is likely to continue to be less demand for US treasuries from China from that front.
So do you think it's something that the market appreciates? Do you think it's factored in? How does it move the treasury market on a day-to-day basis? Because when there was a big sell-off a few months ago, you just added it to the list. China's unloading treasuries, and then there's not going to be as much demand. But now there's been a pretty furious rally here, and people aren't worried as much about it.
Yeah, no, this is very important. So there is a list. So if you just back up a little bit and ask what's driving rates, it's very clear that the economic data, expectations to the Fed, everything that's going on short rates is absolutely a key driver of long rates. But exactly as you just mentioned, Sarah, we have also had a number of other things that continue to be still lingering a bit in the background. Not only is China slowing down, and therefore export slowing, and therefore less demand for treasuries from China. But we also have that Japan is exiting yield curve control. That means Japanese yields have been going up. And remember, Japanese investors hold more than $1 trillion in U.S. treasuries. So if Japanese investors find their own yields in their own backyard more attractive, that's certainly also a risk for U.S. rates moving higher as Japanese investors begin to take more money home. And finally, the biggest risk really is still the supply of treasuries and the supply from the fiscal deficit front that continues to be a lingering issue in the background. So yes, you're right. So far, the rally we've seen in rates in the long end has been driven almost entirely by the idea that the Fed may be done, and I agree with that, and therefore maybe short rates should be going down. But these other issues, again, remember, it's not only more than a few weeks ago we had a 30-year auction that didn't go out very well because we simply did not have enough demand. We will have plenty of 10-year and 30-year auctions going into next year where the market will be revisiting exactly the issue, what are these other things implying for rates. So the bottom line is, yes, so far so good, but the risk is still that long rates will be having some upside pressures coming from these other sources, namely China slowing, Japan exiting yield curve control, and the significant supply of treasuries in the pipeline.
Yeah, we have some auctions even next week, I think, on the longer end of the curve, Torsten. But I guess the question is, does the rally that we've seen so far not somewhat dilute the idea that this was mostly a supply shock? I mean, really, if you pull back, is there anything particularly strange about a 4 to 5% 10-year Treasury yield, given where nominal GDP growth is and given where, where inflation still is?
Well, that's a very important point, Mike. But you're right that maybe we did go up too much when 10-year rates hit 5%. The big question is, where are we going on short rates? If short rates are going down to, the Fed is predicting over the next several years, down to 2.5%, well, then maybe 10-year rates, if you think the term premium or the risk that you're paid for taking more duration should be roughly 0.5%, that means that 10-year rates should go down to 3.5%. So in that sense, we have unwound a lot of the increase in rates that we had. So you're right. So far, so good. It does look like it's mainly driven by Fed expectations and the economy, but let's see these other things. They definitely come and go, and in particular, this issue of auctions, as you're saying, even next week, we got to continue watching very carefully what's happening to the bid-to-cover ratio in long-duration options, what's happening to foreign bidding, how much the primary dealers have to take down. All those things will just continue to intensify because we know one thing for sure, and that is that the supply issue for treasuries is not going to go away. It's just only going to continue to get bigger and bigger as we go through the coming months.
All right, so we'll watch demand as always. Torsten, thank you very much. Good to talk to you. Torsten Tsla,
Thank you.
Apollo chief economist.
All right, after the break, a sharp move higher for Alphabet after yesterday's AI announcement. Shares on pace for their best day since July, up more than 5%. We'll break down why Wall Street is so bullish.
Plus, never in our wildest dreams did we think that a pop star would alter the economics of the country with a cardigan, a cruel summer, and karma. I think that's 4 different song lyrics incorporated into that tease. We're talking Swiftonomics straight ahead. Taylor Swift just named Time's Person of the Year, but she's more than just a pop icon. She's a business powerhouse. Julia Borston with us at Post 9 to break down some of the Swiftonomics, something we've known for a while, but you looked into the numbers and they're pretty amazing.
Yes, Sarah, I'm so excited to be here to talk about this with you because I know you and I have been really interested in the business implications of Taylor Swift for quite some time. So Taylor Swift's economic impact is far more than her concert's $2.2 billion in North American ticket sales. Her tour is estimated to have generated $5 billion in consumer spending in the U.S. alone. Then there's the concert film, which AMC distributed, grossing a record $250 million at the global box office. And then next Wednesday, her birthday, she's offering the movie for rent on a range of streaming platforms. Now, when it comes to streaming music, she was Spotify's top streamed artist of the year with 26.1 billion global streams, reportedly earning her over $100 million in royalties. And Billboard estimates that her streaming revenue, including other platforms, will near $200 million. And that's partially driven by her re-recording her albums. Now, Swift's popularity also boosts the economy in many ways she does not profit from. Etsy tells us that since April, Etsy sellers have sold nearly $5.5 million in friendship bracelets. That's a growth of 30% on a year-over-year basis. And Michaels tells us that sales in their jewelry category, including jewelry making kits, surged 40% since mid-April when the Swift friendship bracelet making trend really took off. Now, with cities where she was on tour, they saw a 300% sales lift in the likes of beads and jewelry from Michaels. Now, in fact, Swifties averaged $1,300 of spending in local economies on the likes of travel, hotel stays, food, as well as merchandise and clothes. That's according to the U.S. Travel Association. They estimate that the total economic impact, including spending by others who did not themselves attend a show, topped $10 billion. And we haven't even talked yet about the 2 million new viewers that she is credited with drawing to the NFL thanks to her relationship with Travis Kelce.
It is mind-boggling, and I feel like she obviously gets a lot of credit for just being a phenomenon and a pop icon and writing her own music and having songs and that people can all relate to. I don't think she gets enough credit for being such an innovator with some of these business decisions, re-recording the album, doing a 3-hour tour, for Eras, and just making all the right decisions about where to take that, extending it for another year. Some of these things that actually CEOs and other leaders we talk to could probably learn from.
And also the decision to release her concert tour as a movie, and this idea of how to expand the audience as much as possible and then give her fans multiple touch points, where a lot of people who paid a lot of money to go see the concert and to get all dolled up to see the concert are then also paying money to see it in theaters, and then also I'm sure will rent it at home.
As an underwriter of a field trip to a different city for my teenage daughters to go see it, I feel all of it. What is interesting is what the impact is going to be next year. We're going to, presumably, she's not going to do another tour.
No,
it's
she's
not going to be
Europe.
But here, same
She's
international.
Yeah,
exactly. So it's international.
I'm going
also,
to London.
You heard about people opening up, the number of people who opened up a credit card account for the purpose of buying tickets. Of course, she has a relationship with Capital One, was phenomenal. And so it's actually moved the needle on a lot of these.
And I actually have heard of a number of people, you said you're going to see her in London, a number of people who are planning summer vacations around a stop to see her in an international city.
Amazing.
It is amazing.
And you're part of it. You're part of that $10 billion.
I'm a big part. I just looked up the hotel bill.
Yeah.
I'll tell you later.
Well, yeah, I mean, it's paying up. I think it's definitely, I think it's something the Fed has mentioned before in terms of the beige book at least. Julia, thank you.
It's great to be here.
For the story we all wanted. Speaking of disruptors, CNBC is accepting nominations for the 12th annual Disruptor 50 list of private venture-backed companies. To learn more, just scan the QR code right there on your screen or go to cnbc.com/disruptors. Julia will be all over it as usual.
Down on the session.
Right, shares of Alphabet now up about 5%. That was a delayed reaction to their launch of the AI model Gemini yesterday. Deirdre Bosa talked about it yesterday. Jay has more in today's Tech Check.
Continue fueling
Mike, I've been trying to figure out how I was going to follow Swiftonomics, but hear me out here. Gemini, I would argue, is pretty mind-boggling as well. Yesterday, the announcement, it did fly under the radar, in part because it was subdued, virtual presentation versus an in-person launch. It's going to roll out in phases, and it's really hard to get across just how incredible this technology is in a written piece, because the breakthrough is in a word, and you're going to hear this more often, multimodal, meaning that the new AI system understands audio, photos, video, and luckily we operate in the world of TV, so we have the advantage of showing our audience and investors the new capabilities as presented by Google in a demo. Have a look.
I know what you're doing. You're playing rock, paper, scissors.
What do you see now?
The fingers are spread out to look like the wings of a butterfly.
What's this?
Big ear and barking mouth, a dog.
Now, here's another example.
What movie are they acting out here?
I think they are acting out the famous bullet time scene from The Matrix.
Now, I don't know if I could guess that as quickly as Gemini did, but guys, I highly recommend the entire 6-minute video if you haven't already watched it. Other examples include Gemini understanding colors, 3D objects, creating games, even cracking jokes. The version demo, though, won't be available until next year, but what it all represents is a new, more powerful phase of generative AI. ChatGPT was, again, first here in terms of going beyond text and incorporating sound and video. Gemini is Google answering back. Now, as part of CNBC's Work Summit, I talked to Marty Chavez, Sixth Street Partners Vice Chairman. He's been studying AI since the late 80s and says that there's never been a more exciting time.
We're well into the second half of the chessboard, and the computers just keep getting faster, and there's more and more data, and the data has been labeled. The internet has helped do that, and all of these things have come together with more theoretical breakthroughs. Everything that I see is about twice as impressive as what I saw 3 months before.
And I think that's how Google's Gemini demonstration made a lot of folks feel once they got a chance to watch it. And so that reaction was a little delayed, but today the stock is surging up more than 5%. And Google has perhaps just regained an edge in the AI arms race that is still well underway. And, you know, yesterday, guys, I was thinking maybe the AI halo effect has lost some of its gleam because the stock wasn't moving much. But today is sort of evidence that we can still get wowed here, and I think many more of those moments are going to come.
It's interesting. Also a reminder that if you go back far enough and talk about how Microsoft was approaching this world before we had ChatGPT really in place, they feared that Google would have a huge advantage just because they have all the data and, you know, all the history in their search business. So this maybe is an affirmation that they do have those resources. I guess the other question is, look, Microsoft stock's not down today. I don't think the market's necessarily viewing it as, oh, here's a killer app that all of a sudden is going to be a winner-take-most solution.
Yeah, and I think that's right. And I think the question's starting to be asked, you know, will these chatbots, is this technology which requires so much money in terms of compute power now, is that eventually going to be commoditized? I had a conversation recently here in Silicon Valley about what Apple's doing, right? They're not mentioned in this race. It's sort of a race between Microsoft and OpenAI, Google and Amazon. You don't talk about Apple, but I think very few people doubt that Apple is thinking about this. They tend to wait a little bit. Maybe when this is all commoditized, they can swoop in and do something really interesting. But we are just in the early stages. And right now, at least, investors, developers, they're looking for the kind of thing that Google put out yesterday with Gemini, more and more capabilities. We still don't really know what apps are going to be created from that, though.
No, not at all. Moving pretty fast. Dee, thanks very much. Up next, why value investors at the Oakmark Fund say Corteva is the perfect example of a stock that's been left behind in this year's rally. We'll trade that name and more just ahead.
Just heads up, 458Cs, they were trading 30 cents when we talked earlier, and I said that's bullish reversal, up 100% in that trade right now.
Let's close out the hour with some stock picks. Our next guest is still finding cheap quality names despite the market trading at high multiples right now, outlining some new ideas heading into 2024, including Phillips 66 in energy and Corteva in agriculture. Joining us now, Mike Nicholas, portfolio manager for the Oakmark Fund. Mike, it's good to have you here. You guys look company by company, stock by stock, don't necessarily make market calls. What's taking you in the direction of, let's say, a Phillips 66 right now?
Well, Mike, first, thanks for having me. We're continuing to find really attractive opportunities in traditional value stocks, really some out-of-favor businesses. And when there's as much dispersion as there is in the market right now, it really provides a lot of opportunities for us to find mispriced securities. And, we think companies like Phillips and 66 both look really attractive, very statistically cheap businesses, strong competitive positions, and we expect both businesses to grow per share value at least as fast as the market over time.
A name like Corteva, which, for those who don't know, is the old agricultural chemicals business of Dow DuPont. Is it one of these that is now priced for an economic downturn? Is it just kind of undiscovered? What's causing the discount?
Well, the shares have been quite weak this year. Corteva is a leading provider of seeds and crop protection chemicals to the agricultural industry. And, both end markets require a tremendous amount of innovation. Farmers expect seed yield improvement every year, and nature develops immunity to crop protection chemicals over time. And as a result, the scaled players in this industry have tremendous advantage. And against that backdrop, we think Corteva is really, really well positioned. They've got strong brands and a very loyal customer base, a very promising R&D pipeline, but the shares have been pressured this year. I think it's a combination of channel destocking and weak crop prices. And to us, we view those both as transitory, and it's really afforded us the opportunity to invest in a high-quality, defensible business at a big discount to the market, its own historical trading multiple, and certainly private market values like Monsanto and Syngenta.
Phillips 66, of course, had activist interest. There is a $1 billion investment by Elliott in there advocating for some management and strategic changes. Is that part of the idea in terms of your long holding there?
Ours is a little different. Phillips 66 is the largest mid and downstream energy company in America. And, Phillips was a part of Conoco until 2012 when it spun off, which is another portfolio holding of ours. And, our view on Phillips 66 is that while it's typically perceived as a pure play refiner, the vast majority of its business value resides in its non-refining assets based on our analysis. And that includes things like its big collection of pipelines and storage terminals, its chemical manufacturing facilities, its retail fueling stations. And, our sum of the parts analysis suggests that these non-refining assets alone justify today's enterprise value, that we're getting the refining operations for free. So we think there's a tremendous amount of upside potential here. And on our estimate of normal earnings, the stock is trading at just a single-digit multiple and well below intrinsic value. So for a collection of mission-critical, infrastructure-oriented assets, it would be very challenging and expensive to recreate.
Right.
We think today's value is a bargain.
Yeah, see if it can get unlocked one way or another, that value. Mike, thanks a lot. Great to talk to you today. Mike Nicholas.
Mike, thanks for having me.
We're having a pretty broad rally again today,
yeah,
Mike.
Picked up.
Quietly, most sectors are up except for healthcare. Right now, S&P is now up 0.75%, NASDAQ up 1.25%. So you're getting a real lift from names like AMD and Alphabet and some new AI announcements.
Amazon also bumping higher as well, and some positive comments, of course, last night from Andy Jassy.
Even though the rally's taken a bit of a pause in treasuries.
Yeah, it's just sort of hanging out there. It feels like under 4.25 on the 10-year is a comfortable place for the market to try to rally. But I will point out, we've closed within 0.5% of 4550 in the S&P for like 12 or 13 days in a row. There's a chance we get above it here. We'll see if it
a little breakout. We have a jobs report tomorrow. I said I think the bias feels like maybe a weak number with the rally in treasuries. But that's it for us for now. We'll see you tomorrow, Scott, and the halftime report up now.
All right, Sarah, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The AI wars, Alphabet firing its latest salvo today. That stock surging as we come on the air. We'll discuss and debate with the investment committee what all of it means to your money. Joining me for the hour, Bryn Talkington, Josh Brown, Bill Baruch. Let's go to the markets. We are green across the board. Dow's having a nice bounce today of some 53 points. It is the NASDAQ where the story is today, though, 1.25%. You heard Sarah talking about that. 412, the yield on the 10-year note. But, Josh, I turn to you first. Alphabet's our chart of the day because
it better be.
It has its Gemini. Okay, so this competition with Microsoft is ramping up. Barron's today says, quote, Google got its AI launch right this time.
Yeah.
This is your stock.
Yeah.
This is your bet.
Yo, how mad is Brad today? Should I text Brad on the break? Make sure he was watching this.
Gerstner, you're speaking
so I'm not, it's not a victory lap. I just have always believed that first is not the thing with AI because it never has been with any previous technological revolution. Ironically, we're like saying, oh, Google's late, blah, blah, blah. Google came like 6 years late to the search engine party. Let's all remember that Google came public in 2004. We had a whole wave of quote-unquote dominant search engines that came and went before they even got onto the runway. So it was way too early to declare that Alphabet's offering an AI was going to be DOA. One of the things I've been saying since the spring, there is no future of computing that Google doesn't play a pivotal role in. And by the way, not only are they not late to AI, they actually were before Microsoft in building it internally. They just went slower. Deep Brain, I mean, we're talking about 10-year efforts in AI internally. DeepMind, Google Brain. They've had AI in the works. So now they got the memo. They're catching up. You can see in the stock price, people like the rollout. It doesn't mean they're going to dominate the business the way they've dominated search. Brad Gerstner is right about that. I just don't think that the domination is the important thing to investors right now.
So this is going to run on everything. I'm speaking of Gemini, of course. Bill, you own the stock too. It's going to run on everything from data centers to mobile. Reiterated buy today. Bank of America reiterated overweight. JP Morgan reiterated overweight at KeyBank. Glowing commentary from the analyst community today as a result of all this. And the stock, as we said, is having its best percentage gain since the summer.
Yeah. Yeah, you know, I think the really interesting thing here is a 20 multiple for this name because of concern about search. And I think this could really reaffirm search. I mean, search is going to be AI driven. I've seen some of this Gemini stuff in work. I mean, it's phenomenal. And for us, we weight Alphabet more than Microsoft in our portfolio. Ultimately, because we thought that the AI that Alphabet could provide or could hit on here was underappreciated, and now we're seeing it.
Yeah, Bryn, you don't own. You don't own either of these stocks, do you? Oh, you own Microsoft. You own Microsoft. So I mean, you have a dog in the fight. But do you feel like Alphabet has closed a little bit of the gap, whether it was perceived or otherwise?
They closed like a sentiment gap, right? So we all saw Gemini can say, yeah, an orange is healthier than a cookie. And so we all need to see the tangibles of what they're doing at DeepMind, which Josh is so spot on. You know, DeepMind is an incredible company Google bought a long time ago. I think ultimately it's like there is going to be multiple winners. And this year is going to remind everybody this was the year of the return of the mega caps. And when you look forward to 2024, what sector is supposed to have the highest growth? Technology. And so I think that although we've had a wonderful year, the last 2 years, I don't think Google's above that 2-year high, only Microsoft and Apple. So it'll be interesting to see if we can see continued multiple expansion and move past that 2-year high that most of these names have not breached outside of Microsoft and Apple.
It's crazy when you look at I know that we all know that mega cap has led, and to the degree which it has, it's nonetheless crazy when you look at the 12-month returns for these stocks. That Microsoft's up 50%. Now, I know the stocks got hammered a lot in 2022. That Alphabet's up 45%. That Amazon's up 66%. AMD's up 78%. And now you've got this repeated news. It's no surprise, Bill, why AI continues to dominate the investor conversation, why it remains among the best idea stocks from investors, and where they continue to lean in. relative to everything else, which there are a lot of calls for catch-up trades, this, that, and the other. But that's where the action is.
Yeah, I think, I mean, a lot of rotation talk earlier this week and last week as we saw the Dow continue to move out. I think that's premature. And I really think that the leadership is going to be maintained here in tech as the year finishes out. Now, when we do look to next year, I believe, yes, healthcare and banks, they could really start to perform a little better. We could start to see a little more cyclical. But this AI revolution that's been taking place, it's a narrative that we keep seeing headline after headline that reinvigorates a dead tape.
Whether we're playing this up too much or it is what it is, it seems to be a battle royal.
Put up AMD, though.
Between these. We're going to get to that in a minute. We're going to get to that in a minute because that remains a part of the umbrella story, too.
That's the battle royal now.
And we'll talk about that. Well, that's another one. Maybe you need a couple of octagons. For you can put NVIDIA and AMD. They can square off on a co-main event with Microsoft and Alphabet. Because Steve Kovac, I mean, it feels to me like that's really what you have here, a battle royal between these two companies. Microsoft has had the lead, and Alphabet's been not so fast, and we're going to show you, well, now they're showing.
Yeah, that's exactly right, Scott. So look, here's where we are now. I know Josh was kind of talking a little bit about where things are headed, but today the AI race is tightening, but Microsoft and partner OpenAI is still about a year ahead of Google if you add it all up here. Google shares up today, of course, following the announcement of Gemini, that new AI model that'll eventually be part of its chatbot Bard, plus other products like search and productivity apps like Google Docs. Unclear, though, why shares didn't really react to the news yesterday, but it is the optimism around Gemini today seen as the force driving it up about 5.5% now. But it's going to take a while for Gemini to roll out and even longer for Google to start monetizing those capabilities, especially in search, where the company has said it'll see the big benefit from generative AI. Also unclear the impact it'll have on Duet. That's the productivity assistant it's previewing now for business customers and eventually plans to sell at the same price Microsoft's selling Copilot. Google execs also dodged questions about whether or not Gemini is better than OpenAI's latest model, GPT-4, but they did say it can outperform GPT 3.5. That's the free version of ChatGPT a lot of people are using right now. Meantime, Microsoft just plowing ahead. It's already added its OpenAI-powered Copilot across a range of products like Windows and Bing, and it's selling Copilot to business customers at a hefty price. Not to mention the benefit its Azure cloud gets from all those third parties tapping into OpenAI's model as well, guys.
Yeah, I'm looking at I mentioned the calls on the street today, Steve, and the kind of language that the analyst community is using today, where one is talking about Alphabet's AI capabilities, that this shows it, that this is a significant innovation, that they're showing their muscle development. All the things that theoretically were being questioned in the last 12 months or so, because it was deemed that Microsoft was the power lifter, right, and that Alphabet was just going to get the scraps.
Yeah, and that's part of it, but also what's true here is that Google had all these capabilities and they'd been sitting on it for so long, and now they're just trying to play the catch-up game. And I'll just point out that, some of the stuff that we're seeing from Gemini, you can't use it yet, Scott. It's going to be a couple more weeks or months before the most capable and advanced models of Gemini are to come out. I'll point to some skepticism also coming out. The Information had an interesting report this morning, kind of throwing cold water on this demo video we're showing you right now that CEO Sundar Pichai shared on his social media, showing this is called multimodal, what we're looking at right now. That means it can both look at images and text and voice and kind of collate all that together. Based on the way they showed this demo, though, the Information report kind of casting some doubt. Maybe it was kind of carefully crafted to make it look more capable than it will be when you actually put it into people's hands. Again, we just don't know because this model hasn't come out yet. People haven't been able to really play with it. So, always have a little dose of skepticism when you have a pre-recorded demo like that. They could easily cut around it. If you look at their blog posts, they kind of explain how they actually got Gemini to do what we saw it do. It's a little more nuanced than just kind of the whiz-bang stuff Pichai shared on Twitter.
Yeah, I appreciate it, Steve. Thanks very much for putting all of this into perspective for us. As Josh, I turn back to you. I mean, look, the narrative is going to be, until it isn't, that this is Microsoft's lead, that they made the most significant advance. That's why there was all the hype about it. And that Alphabet's still going to have to play catch up in some regard. To Gerstner's point, which may be the overarching point of all, you know, he gave the example of being in a room speaking to 1,000 people. Who uses, you know, Chat GPT or whatever? Everybody raises their hand. There's like scant number of hands go up when you talk about using
Scott,
Alphabet.
if we would have done that in 1997, asked a room full of young people when they used the internet, what do they use? They all would have said AOL. I don't think that matters. I know it matters now, and I know it's the story so far. Stories change. This is what I think matters. Large language models will be ubiquitous. There will be many of them. What's really going to happen in the next phase when you talk to technologists and the people that understand how you turn a technology into an actual product, what's really going to happen is hyper-specific large language models to address certain industries. You're going to, every industry is going to have its own champion. Now, some of these will be overarching and address all of it, and that will be the dominance, but that's not going to be the important thing. The important thing is going to be who can get their users to interact with these models and pay for it. And Microsoft will do great, I have no doubt, but Google has 1.8 billion with a B Gmail users. That's just one part of what Google does. We won't even include any of the business services or the cloud service or YouTube. Put it all aside. Just Gmail alone. Imagine waking up in the morning and telling Gmail to respond to all your emails. It's literally going to do so in your voice. I know it's not today. That's where we're going. And so I think there's a lot of room for multiple platforms to make money.
All right, so your highs of the day there for shares of Alphabet, as you see, and we can keep those up. Look, maybe 2024 is going to be the year then where Apple makes its big splash in its own right for a stock that's at $195, back above $3 trillion bill in market cap. Let's not forget about that stock because it's been an absolute beast. It just doesn't get talked about in terms of AI as much as either Alphabet or Microsoft do.
Yeah, talking about Apple in particular, I mean, the price that held at 170, I think phenomenal. But the key word across Microsoft, Alphabet, as well as Apple is ecosystem. They all have a fabulous ecosystem. And I mean, look at Microsoft, the Copilot, 40% quarter-over-quarter increase. Apple's ecosystem, I mean, the services part of their business is growing and becoming a bigger piece of the pie that they have. So I expect Apple to be setting a new record high here, I mean, as we close out the year.
All right, let's do AMD because it's surging on its own AI announcement, of course, these new chips. It wants to take on NVIDIA, too. And that's a big part of this story. Josh Brown, you made the case for AMD when you bought it recently, and I know you wanted to talk about it, so let's do it right here.
Yeah, look, I bought a little bit of AMD. I obviously didn't buy enough. You never buy enough of the ones that run 20, 30% immediately. So it's not a big position for me. I'm much bigger in NVIDIA, but I want to be in both. And I talked a little bit about Lisa Su and how aggressive AMD wants to be in inference chips, in the training chip market. They're going to play. What they don't have that NVIDIA has is the ecosystem. They don't have the same software offering, and they're not as dominant there. But they can make inroads. They don't need to get 50% of the market. This is not Coke versus Pepsi. They can get a really big chunk of the market, and they do have a software platform. So some people will be standardizing on AMD's AI chips. It's just a fact. So how much of that is in the stock? Maybe a bunch, but not all. I still think there's room for this name to trade higher. So I'm going to stick with both holdings. I don't see that as contradictory to believe that there's enough room for both to win.
This is ripping. Bill, you own AMD as well. Then we'll get to the NVIDIA side of it with Bryn. I know all three of you own the stock, but give me something on AMD. That stock's up near 7%. We could have easily done it as our chart of the day, but the Alphabet move is so outsized that how could you not?
Yeah, I mean, they're implementing chiplet architecture, which will make their GPUs more scalable than NVIDIA potentially. And as I've pointed to before, I think that AMD is eating into a little bit of NVIDIA's lunch on the software side of it. NVIDIA is still #1, but now AMD could be #3, and kind of just eating in there just a little bit. So we own both. I mean, I think we have to have exposure in both of them right now.
You want to hear something crazy? They're cousins. Do you know that?
Yeah.
Jensen Huang and Lisa Su. They're both from Taiwan, and they're like distantly related.
Well,
and
this is
she's
a
wearing
big
leather
deal.
jackets now, which I like everything that's going on in this space. I have to be honest with you.
Yeah, there was a big deal yesterday in the interview, of course, that Dr. Lisa Su had with Christina Partsinevelos. Bryn?
Yeah, I mean, first of all, it was reported that this year, both Meta and Microsoft purchased around 150,000 each H100 and H800 chips. And so it's like Microsoft, of course, is going to partner with AMD. No one wants one company to have a monopoly here. And also, you know, margins do mean revert. And so I think that you have, I'm not surprised. I didn't know they were related, Josh, but not surprising because Lisa Su and Jensen Huang are probably the two best operators that we have. But there's for sure more than room for one. And I think that you will see more big companies like the Microsofts, like the Metas, which are the two biggest buyers of NVIDIA, wanting to diversify their supply lines, not only with what they're creating, which I don't think is going to move the needle, but AMD is going to absolutely be a winner over the next few years because Jensen and Lisa have both said this is $1 trillion data spend over the next decade. We're just in the first innings.
Yeah, it's the, you know, this is obviously the rising tide that's lifting all of the AI boats. Broadcom included, by the way, which reports its own earnings in overtime tonight. Bill, you used to own it. You sold it. It's had a remarkable run in its own right. It's up 77% over 12 months.
Yeah, we owned it. Now, the way of piecing this portfolio together, we had two very tactical plays on during that time that run in June through July, owning Broadcom and Tesla. Those are the first two I cut. I mean, it was really, we were so bullish at the time. So again, very tactical. I don't dislike the company. I just can't fit it into the portfolio right now. What I do like from a price perspective is it broke out of that 900 mark, and now it's retesting support going into earnings. Their operating margins they're one of the most efficiently run semiconductor companies, and I think that if we look at that, if they continue to confirm that, I mean, this stock, it's going to be on my radar to be buying again. I just got to find a way to fit it into the portfolio.
You did sell Marvell.
Yes.
So maybe you have some space.
Yeah, there was an ad, a sort of a swap. I think we'll cover later in the show. I won't say it right now. But yeah, Marvell it hasn't lived up to what we were hoping. Big move today in Marvell. Took advantage of raising a little bit of cash there. It was in our bottom 10. Now the problem is they connect data centers, and it's not really on the GPU side, so not really benefiting as much as we would have hoped in this big AI craze. So that's something right there that I think could hold it back.
It does lead to the conversation, because this dominates the conversation about what these stocks are going to do in the year ahead. Will you have a similar makeup of the market move that you did this year, in which the biggest stocks in the market obviously led the way, and now we're talking about catch-up trades like you've had from November until now. Savita Subramanian over at Bank of America, Josh, says new S&P high without Mag 7 leadership, easy. 5,000 for the S&P next year. Don't need Mag 7 leadership at all. Even if they flatline, you can get pickup from everywhere else. What do you think?
Listen, that would be great. I think historically, unfortunately, anytime that you've seen this big of a spread between the top 5 or 10 stocks and the rest of the market, the resolution has actually been a catch down. And what that means is other stocks have held up well, those big stocks have come in, and it's been in the midst of a correction. It's rare that you would have this much outperformance of the best stocks, and then all of a sudden everything else comes roaring back and matches. It could happen. It doesn't never happen. It's rare. I hope she's right, though. That would be nice. Most of us on the desk on the show each week own more than just the top 7 stocks. But I have to tell you, just do an eye test. You don't need stats. You don't need to give you data on internals. Look at your portfolio. Almost everything looks amazing right now. If you just look at 90-day charts on your top 10 or 20 positions away from Mag 7, you probably agree with me. This is the time of year that we're in. This is what happens. The tax law selling is over. Even the dogs get a little bit of love. There's another layer of growth companies that's not Mag 7. They've all had tremendous results. I'm just looking at names I'm in, like Zoom is ripping now. CrowdStrike hit a new 52-week high yesterday. These are not Mag 7 stocks. They're just growth stories that are working. And in that vein, I've had the opportunity to make a couple of sells this fall and winter. I don't know. We're going to do this one next?
No,
Okay.
we'll do it coming up.
Okay. All right.
But the only place I guess you wouldn't want to look at for great performance, Bryn, would be energy, which you do have a lot of, and it's down again. So oil gets a day's worth of stabilization. We'll see if it amounts to anything, but we're talking $70, and it's been on a steady stream lower.
Yeah, I mean, I think ultimately what happened is like today you have news more about inventory bills, but I think the narrative around China is the elephant sitting on energy prices, and the data out of China continues to get weaker and weaker. So while the U.S. economy is humming right along, that China data, which is so important to global GDP, continues to weigh on the price of oil. But ultimately, I think that early next week, energy's really sold off. I think you're going to get, as a trade, a really good time to step in. You're already seeing it stabilizing today. So I wouldn't give up on the asset class. I definitely think it's a good trade, but until China stabilizes, I think you're going to continue to see weakness to the downside in the space.
Let's just note, too, I'm looking at a high of the day for Alphabet. Let's just show intraday on the back of your guys' conversation about that. Almost 6.4%. NASDAQ's ripping now. It's up near 200
It's a
points.
big move for a multi-trillion-dollar market cap.
Yeah, we said the biggest,
a lot of dollars.
Biggest percentage move in Alphabet since July. Of course, there are a lot of bears out there still, and they're not convinced that Mag 7 is going to do as well in the new year, nor are they convinced that risk assets in general. Marco Kolanovic, like clockwork, right before our show or during, puts out a note. We're not positive on the performance of risky assets and the broader macro over the next 12 months. Primary reason, interest rate shock that's already happened that's going to negatively impact economic activity. Doesn't matter if there's a recession or not. Hard to see an acceleration of the economy or a lasting risk rally without a meaningful and significant reduction of interest rates. What do we think about this, Bill?
Well, I mean, right now, it's hard to say, okay, I fully disagree with him, but he's making a point here.
You say whatever you want.
Yeah, and I'm not negative going to next year, and I think the growth's going to kind of stay steady. We're not going to, just see the things fall apart. One concern I really do have is the rate cut of going into March is the Fed watch tool in the CME group.
You think that's a little aggressive by the market to think that in 3 meetings time you're going to get your first cut?
Yes, and the market could be disappointed with that. Rates will rise from there, and I think that could be a little bit to digest. I do think he made a really good point on the tailwinds coming into the year, China reopening, but it wasn't much of a tailwind because it really kind of died off quickly. And Bryn made a point about China as well just now. And I think for energy it's a little concerning, but there's other stuff. I think China, there's some import data last night for copper was huge. I think there's some stuff here that globally the growth is going to stay very steady, and so I'm not negative. I don't see that being a negative point.
You're indirectly teasing a new move that you made, which we're going to do in our following block. I see you. Josh tried to do the same thing, but we'll wait after the break. But what about this Kolanovic note?
I mean, a year ago, he was saying the rally off the October lows is a bear market rally. Avoid risk. I mean, it's July, he was saying AI bubble. I mean, if you had followed many of these kinds of warnings, unfortunately, if you're a professional, you're trailing like big time. It's really, really hard to catch up to the NASDAQ up 50%. It's really, really hard to catch up to an S&P up mid-teens percentage, almost 20%. If at the current rate of rally. So a lot of the people who you see buying these stocks now at 52-week highs, who do you think is chasing AMD? Who do you think is chasing Alphabet here on AI? It's the people that in July said, you know what? Yeah, it's a bubble. I agree. So it's difficult. I'm not particularly good at calling these shifts either. So no disrespect, but I try to like understand the point the strategist is making, but then not rearrange my whole portfolio as though that's the only outcome that could possibly be true.
All right, speaking of your portfolio, so Josh is selling a name that's done quite well this year. He's mentioned it many times. We're going to tell you what that is after the break. Bill indirectly teased a stock that he just bought. Tell you what that is in a couple minutes when halftime returns. All right, we're back. Let's go through these names now. Josh Brown, you sold AOS, A.O. Smith, housing play, hot water heaters, and the like.
Yeah, so I had expected A.O. Smith to trade more in line with the home builders.
Which have ripped?
Yeah, I mean, it's gone up, but it doesn't go up enough. It doesn't match that space. So it was like an inferior way to play something that I was right about. I just expressed it wrong. So the XHB, for example, is up 50% on the year.
Well, I mean, let's be honest. It's not like you expressed it wrong. The stock's up 35% year to
Stop
date.
trying to make me feel better.
It's just
I should have just bought a home builder.
I mean, the home builders have been hitting all-time highs. I get it, but I mean, the stock's still up 35%.
Right. You know, I have two weaknesses: polio string cheese and trying to get too clever with my trades. What I should have done was bought the index of home builders, but instead I bought the hot water heaters. It's a great company. I think actually chart looks great. I think the stock could work its way higher. One of my big ideas for 2024 is that rates are going to moderate. Mortgage rates are now crashing. They've been coming down 6 straight weeks. I think the deep freeze in the housing market is going to unfreeze. I want to be a player there. I have names like Zillow on my radar. This is no longer going to give me enough bounce if I'm right about that idea for next year. So goodbye to A.O. Smith. It worked. It went up. I'm happy. It's a 52-week high right now. I just think that there are going to be better places to be if what I expect for next year plays out.
I don't want to gloss over Zillow is high.
I don't own it. I'm just, it's like,
you don't own it.
I'm watching it. I'm looking at certain REITs. I think there's going to be a better place to play.
Okay, so we'll watch that one. That's letter Z. Bill, you bought Southern Copper Corp. We mentioned, you indirectly mentioned that you had bought a copper-related thing, and that's it, SCCO.
Yeah, it's I think the best pure play in copper. I know a lot of people look at it Freeport, but Southern Copper is really, I think, the best pure play in copper right now. One of the things that quietly has taken place over the past couple of months is the Chinese yuan strengthening against the dollar. It's up 3.5% against the dollar, which is a big move. And China has been destocking commodities. I think as we turn into this year, we're going to see a lot of demand, a lot of new imports. And that import data, shout out to Ola Hansen of Saxo Bank. I saw it early this morning. 10% increase month over month, which is the highest in almost 2 years on copper being imported from China. So I think this is the start of a big turn in commodities as we look into next year.
You know, the sort of segments billed as like buys and sells, obviously, but there is news around other committee names too. Bill's yours included Domino's. Investor Day today. You just bought it last week.
Yeah, I mean, it's performed. I mean, the timing was really well with that. It's performed really well. One of the things that stood out to me most is the search analytics. In middle of September, they launched a new loyalty program, and ever since then, Domino's has been search results have been increasing. On top of that, they're going to be on every single store on the Uber Eats platform, I think, in the turn of the year. So that's going to be another tailwind to demand.
Put up that chart, DPZ. Can we put real quick?
I was going to say, the weakness doesn't extend to the thin
crust?
crust?
Give me like a 3-year or one, like pull it back. I don't do intraday. All right, whatever.
One of the best performing stocks, yeah.
Let's say you knew nothing about technical analysis. What do you think happens here? 400 has been significant resistance back to last summer. It's 18 months. Every time it's gotten to this level, it's hit a 10 on that ceiling. When it punches through, and I think it's about to, what do you think happens here? This was, what was this, $600-700 stock?
Oh, yeah.
All right. I love that. Domino's fits within this theme of stocks we threw away because we thought they were only good for work from home. We thought they were only pandemic era. Domino's absolutely is in that category. I referenced Zoom before. That one technically is starting to set up just like Domino's. I really think there's an opportunity in a lot of these names we've thrown out that are getting this comeback here at the end of the year. We're starting to recognize that these brands mean a lot more than just, hey, I'm home, I might as well go on an app and order something. I like this DPZ call. I think it works its way higher.
Well, there's no better way to feed a family of 4, and especially from...
Well, that's not true.
Well, I mean, I think as in how efficiently and timely, and any evening...
What do you think about that?
You're going to say something like that to this guy?
There's a better way.
There's a better way, but you know what I mean? But their target audience, for their target audience...
There's no better way to feed a family of 4 at 1 a.m. after they all come home from a wedding. That's the Domino use case for a family
efficiently for at a low cost price point.
All right.
That's where they're going to accelerate.
All right. The other stock in the news today, Bryn, is yours, AbbVie. The second big deal in a couple of weeks.
Yeah, close to $20 billion between Immunogen and Cerevel. And so this is a good example is outside of energy, healthcare as a sector has the highest free cash flow yield. And this is a perfect example. AbbVie, going into these, I think had a free cash flow yield around 8%. And what are they doing? They are building out their oncology and their neuroscience with these two acquisitions. I think what's most positive is making two decent-sized acquisitions, and really the stock is up on the week. So the market likes this. AbbVie has come out and reaffirmed that $11 trough earnings. And so I think the market's like they're investing in their future. This helps them with their pipeline. And we'll see in the next few years if these two acquisitions were accretive to the earnings. But I think it's very positive. The stock's been up for the week.
All right. Bertha Coombs has the headlines for us. Hi, Bertha.
Hi, Scott. Authorities say more than 18,000 pounds of cocaine from 6 separate drug smuggling seizures were offloaded in San Diego this week. The cocaine was recovered by the Coast Guard off the coast of Mexico, Central America, and South America. It estimated to have a street value of nearly $240 million. U.S. Customs and Border Protection reports more than 40 tons of cocaine were seized so far in 2023. Denmark's parliament passed a law today making it illegal to burn the Quran in public places. The move is an attempt to de-escalate tensions with Muslim countries following a series of Danish protests where Islam's holy book was burned. The new law also covers other religious texts. And prosecutors are accusing a former Jacksonville Jaguars employee of stealing more than $22 million from the football franchise. Court documents allege that the employee exploited the organization's virtual credit card program and that between 2019 and 2023, the employee allegedly used the cards to purchase 2 vehicles, a condominium, cryptocurrency, and, of course, a designer watch. Scott?
I thought you were going to say, of course, the cryptocurrency part, but neither here nor there. Bertha, thank you very much. Appreciate that. That's Bertha Coombs. Coming up, calls of the day, including top picks in financials and software. We'll do that after this quick break.
Bank Canada's Gravel says in her statement that while we saw welcome improvement in October inflation measures, we need to see further progress. We have made progress on restoring price stability, but we're not there yet. Canada needs more homes, and we need to make our housing supply more responsive to increases in demand. Housing imbalances has serious consequences for shelter price inflation. In October, it contributed 1.8 percentage points to total readings of 3.1%. And we need all levels of government to work together on a variety of housing policies to boost supply. Jump in demographic demand coupled with existing structural supply issues could explain why rent inflation continues to climb. Housing activity grew 8.3% in third quarter, but this is far below what is needed to make up with the growing housing needs. Rent inflation accelerated to a 40-year high in October. Housing supply has not kept pace with recent increases in immigration. Also, on that, he says that these indicators are helping us assess whether inflation is on a sustained path of 2%. And the economy is now roughly in balance, but we are closely watching inflation expectations, wage growth, and corporate pricing behavior. Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
I'm a member.
Just a reminder, at 12:50 to begin this time is when the press conference is due to begin with Bank of Canada's Gravel.
All right, calls of the day. First up is Goldman, named the top 2024 pick at KBW. $400 the price target, above average growth expected. Inexpensive balance sheet relative to the return outlook. Bryn, you used to own Goldman, but you sold it, I don't know, what, 6 weeks ago?
Yeah, that's about right. I mean, listen, this has been a year of transition. Goldman, JP Morgan, Morgan Stanley are three of the best banks. If you think M&A is going to improve next year, I think Goldman's a natural buy. I would just rather own my NVIDIA, sell calls against it, own more healthcare, some other names there. I just don't want to be in the financials. I still think the private credit firms are doing all of the things the banks used to do, and that the banks in general, outside of M&A, are much more anesthetized and will never have that growth that they had prior great financial crisis.
We have rebound trade and financials coming up.
I mean, if you're going to have a bubble, if you have a bubble next year, Goldman will do great. That's when that stock outperforms, when there's a speculative bubble. 2021 is a really great example of that. It's one of the best years ever for shareholders in Goldman. The downside always looks like this. So, that's the type of stock it is. If you're really, really bullish about underwriting coming back and IPOs and M&A and LBOs and all of the acronyms, yeah, Goldman's going to work great. Absent that, hey, it's a little bit of a shambles in wealth management right now. They're trying to get their bearings. They bought this United Capital. It was a huge blow up, didn't work. Peter Mallouk stepped in to buy whatever was left of it. I don't really know what their strategy is there. They're trying to build a custodian. It's not the greatest business with free trading. So you have that. If you're not going to get a big investment banking boom, I don't really know what else you'd be in the stock for. I prefer Morgan Stanley.
Also,
I think they're kicking ass in wealth management, and they're going to play in an IPO boom. So if I have to choose one or the other, I think MS over GS.
JPM's the one you do own, the only one of the majors.
Way less reliant on big stock market booms. Like JPM will play. They're number 1 or 2 in every category. They're not reliant upon it for earnings growth in the way that Goldman is. Goldman's growth engine was supposed to be consumer fintech. It didn't work. They're exiting those businesses. I don't know what's behind it. I do know if we're going to do another 300 or 400 IPOs, Goldman's going to do really well. Are we? It's an open question to me. So I'm not sure.
Bill, Adobe, a couple of nice calls today, reiterated by Jefferies. That's ahead of earnings. The stock's had a great run. They go 660 price target. Also reiterated Morgan Stanley, same price target, $660.
Yeah. I mean, this is the actual implementation of AI. I mean, their Firefly image generation tool, that really starts to when they get that fully launched, that's going to be a great tailwind. If you think about it, they got 20 million subscribers and a lot of data that's going to be pulled from there. Between 2020 and 2022, 165 million creators hit the creator economy. There's a big market for Adobe to address within that. And Morgan Stanley, Keith Weiss noted they're light on the numbers, but the vision is big. And I think that's what you got to take away here. The big vision. And last year, it broke below $600. It's battling at $600 right now. The longer it stays there, I think technical support kicks in too.
Comfortable with the 35 PE?
Listen, I mean, a software company, it's going to be technically a big higher of a PE, but you're paying for, you're really paying for the vision, if you will.
Well, we'll see if the vision comes to fruition. All right, Mike Santoli, he's next with his midday word. We're back after this.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
All right, we are back. Our senior markets commentator, Mike Santoli, is on the desk for his midday word. So, you know, we had a huge meal in November. We had gone through this digestion. We thought we were still full. And then somebody put a beautiful piece of AI cake in front of us today.
Sure.
And we decided we couldn't resist.
For now, yeah, within a band, that's what's going on, and there is always something idiosyncratic that usually has to get a market moving again. Once we've been going sideways in this way for a while, I was saying earlier, 13 straight sessions, if today is included, where we finished within 0.5% of 4550 in the S&P, and yet within it, you know, the average stocks maybe doing a little bit better. I don't know that it has to be an either-or market. I know we got used to this idea that it's either a black or red, it's either a mega cap day or a Russell day. They can go either direction from here. You can see the market kind of unsure if we have the horses at this level to really carry us ahead without, I mean, maybe just waiting for the jobs number tomorrow to be absolutely perfect and Goldilocks like every other number this week has been, to see where we go. It reminds me a little bit, I was looking back when we've gone flat after a rally like this for a long period of time, and it really did happen in the spring. After we got the huge lift off the SVB low and people thought the Fed was going to be very easy.
Be careful of a liquidation break here.
Chopping around before it did
could be a
dissolve
swift
higher.
reversal
Energy
down
just can't
and
get out of
up
its own way.
off of the hourly half-hour trigger.
I mean,
Just
you know,
be
people are
careful.
saying that
Have some stops down below. We can still squeeze up here. Just be aware there could be a shakeout, okay? Can you guys hear?
the seasonal negatives on crude maybe.
Just be aware of a shakeout here, okay? Got a little bit of a flattening of the 1 in 5 minute trigger. You know that your real support is down on the half and hourly trigger. Oftentimes when you get that cross of any triggers, like the 1 in 5 minutes or the half hour and 1 hour, we'll quickly go back and just test those things. So don't panic or have stops or have the ability to adjust. Remember, trade fast, right? Dodge and weave, all that kind of stuff.
Overthinking it beyond that, as we discussed yesterday, I'm not convinced it's some kind of scary macro signal yet.
Yeah, it's been an everything rally except for related to energy and oil. I'll see you on closing bell. That's Mike Santoli. Everything rally, including crypto, that's been breaking out. Burning some short sellers, too. Our Kate Rooney comes up next because she's following that money when we come back.
So as said, at 12:50 p.m. Eastern Time, we're expected to see the live stream of Bank of Canada's Gravel speaking. So the dollar continuing to head lower amidst bets that the Bank of Japan will scrap the world's last negative interest rate regime as soon as this month. So again, just sentiment from the news from overnight in the Asia session continuing to hit the dollar here. And also the yen not letting up on its current strength.
Bitcoin's been on fire lately, as you know, soaring past 43,000. That's the highest level since early last year. There it is, 43.2. But that big breakout is burning some crypto short sellers. Our Kate Rooney's following that money for us. Kate?
Hey, Scott. So it's been a tough time lately to bet against some of the crypto proxy stocks as Bitcoin has risen. You've got Coinbase and MicroStrategy in particular. Those have been some of the best performing tech names this year. They're both up roughly 300% since January. Data from S3 Partners now showing that short sellers have lost more than $6 billion this year on crypto-related bets. More than half of those losses came from Coinbase shorts. Became more of a popular trade this fall. Short sellers increased exposure in September to what they thought was an overbought sector. According to S3, short sellers are down $2.7 billion just in the past few months on those crypto trades, or in percentage terms, that's off about 148%. Part of this rally, likely a short squeeze. You've also got individual traders now chasing some of this momentum. According to Vanda Research, individual traders started rotating out of some of the big tech names into crypto and small caps, which there's a bit of an overlap there. Coinbase and MicroStrategy have benefited from these retail inflows, as well as some of the Bitcoin mining names, too. Vanda analysts point to that upcoming January 10th deadline for the SEC's potential approval of a Bitcoin ETF, causing a lot of this excitement, they say, being a very momentum-driven asset class with a clear catalyst on the near-term horizon. They say we wouldn't be surprised if we see retail traders continue to pump flows into the space over the coming weeks. Scott, back to you.
Yeah, Kate, thank you. You have a thought on this? Because FOMO, as Kate said, anticipation of ETFs, and it's just been going in that way.
If you think you missed this and you want to play catch-up, one under-the-radar way to do it would be Robinhood. This is a stock that used to move tick by tick with crypto, and there's been a disconnect. But if you think about the main driver of profitable activity on the Robinhood platform, it is crypto. So this is a heavily shorted stock. It's been out for the count. It's rebounded a little bit off its year low. That might be a way in the stock market if you wanted to. I don't want to. I'm not putting this trade on, but it's just
Why
something
not?
that.
What's the difference between liking the potential of what Robinhood could do, but
what
still
I'm describing
not wanting to buy the stock?
because I'm more of a long-term investor. What I'm describing is a short-term phenomenon where this is a name that could run up into year-end as everyone anticipates the first crypto ETF. The big winners of there being a first crypto ETF probably going to be Fidelity, BlackRock. I don't really think there's a trade there, but it's a legitimization of the asset class in the eyes of Wall Street. And I think it does bring investors back into playing in this space. And I think, look at Coinbase has quadrupled this year. Robinhood has not. Coinbase, obviously, a much bigger player in crypto. But again, one of the big drivers of Robinhood activity is speculation. And this is speculation writ large. So if it's coming back, they'll be back to trading on the Robinhood platform.
Bryn, what are your thoughts about the space right now?
Yeah, I mean, I think if we get this ETF, obviously, to Josh's point, investors will say, if it's good enough for BlackRock, we want some of that. I think where you kind of have the FOMO and that greater fools theory is, from what I understand, which could be wrong, there's about 16 to 17 million Bitcoin in cold storage. So that only leaves like 5 to 6 out there to trade. And so all of a sudden you have this scarcity and you have an ETF, which I don't really understand the math. If you only have 5 or 6 million Bitcoin and you have an ETF, how do you actually back that up? I get it on gold, but I think right now, going into the year end and going into January, you're going to definitely, FOMO is alive and well. And I will say, this crypto community wins again. It's pretty incredible after what happened last year with FTX, Voyager, et cetera. How,
all the ones that stayed out of jail get to win. The key was you had to not go to jail, and if you survive that, you get to win again.
Yeah.
All right, we'll do final trades on the other side of this break.
Just heads up, Tony Gravel is currently speaking live at the live stream.
Dental.com.
Hope you watch me closing bell today, 3 o'clock, because we got Tom Lee. Tom Lee. When you think of Bulls, who do you think of, Josh Brown?
Only Tom Lee.
Only Tom Lee, right?
He owns it. That's his lane.
All right. Well, we'll see what he has to say about the year ahead.
Jimmy Leventhal, too.
That's true, but Tom Lee's kind of in a class
Uber Bowl
by himself, right?
Uber Bowl, yeah.
You think of Bears, who do you think of?
I don't know. I forget their names these days.
Mike Wilson.
Are they still out there? I'm just kidding.
No, he's had one. All right. Well, I hope you'll join us at 3 o'clock on Closing Bell. Bryn, you have a final trade?
Yeah, JEPQ, it owns the Qs and sells calls against it. So if you miss the run-up in these names and you think they're going to do well next year, JEPQ. If you think they're going to be flat, you have about an 11% covered call premium, and so you can earn some income while you're waiting.
All right. By the way, we're going to run you up to Broadcom earnings, too. I want to let everybody know about that, which are going to be significant after the bell. What you got, final trade, Bill Baruch?
AbbVie, if the S&P is going to set a new high without the Mag 7, it's going to be names like this, financials and healthcare, going to be driving it. Now, they're replacing the Humira pipeline within their pipeline, adding to things, and it's a hated name by mutual funds and hedge funds. Hedge funds are short this name. This thing could really drive this to new highs in AbbVie.
JB.
Staying long AMD. I should probably sell, but I'm not. So there we are.
It's up 8%.
I know.
I know. Today. All right, does it for us. I'll see you on Closing Bell. The exchange is now.
$5 billion in December week.
Thank you very much, Scott, and welcome to The Exchange. I'm Kelly Evans, and here's what's ahead. Bond yields have dropped sharply in recent weeks, but our guest says not so fast. He thinks the 10-year is headed back over 5% next year and is in the no-landing camp on the economy. We'll debate ahead of tomorrow's big jobs report. Plus, airline stocks rebounding today, but it's been a disappointing few months for many of them. And yet one supplier is hitting its highest levels of the year. That CEO joins us in an exclusive ahead. And there are two housing stocks our analyst says are especially well-positioned into the new year. And he's a name you can trust. He's got the names and how much upside he sees ahead. Before all that, though, let's start with the markets. Dom Chu has our read and our numbers and the momentum. And what do you make of it all, Dom?
The momentum's been in certain parts of the market, Kelly, and specifically within technology stocks. And that's the reason why you have the NASDAQ composite, the NASDAQ 100, the large cap names in it, really doing a lot of the heavy lifting. It's green across the screen right now, but it wasn't like that during this morning. It was a very mixed trade. But as things stand, I mentioned the NASDAQ composite. It's up nearly 200 points, 190 points to the upside, 1.33% gains, 14,337. The Dow Industrial is the real laggard, only up 0.25% or 92 points, 36,146. And the S&P 500, that broader measure of the stock market, 45.85 is the last trade. They're up about 37 points, 0.75% gain. This, by the way, would represent just around session highs at this point. At the highs of the session, just about up 37 to the downside. Well, if I could write on there, it would say 37 points, 16 points to the upside on the lower end of things. We'll keep an eye on that. Oil prices also trying to find some positivity right now, trying not to work off towards a 6-day losing streak. As you can see, just about flat on the session right now, still below $70 per barrel for U.S. benchmark West Texas Intermediate, $69.35. The level that a lot of folks are still watching right now is $78. That's right there. As you can see, that $78 mark is where that long-term 200-day moving average is. So keep an eye on crude prices. Remember, it was supply concerns for gasoline yesterday that drove a good amount of the downside, trying to find some bit of stability today. And then Kelly mentioned the airline stocks. Let me show you just how strong they are today. They're among some of the biggest gainers overall in the market. Now, JetBlue Airways up 13%. They updated their fourth quarter and full year sales growth guidance better than it was prior. And so that's helping that particular move. And by the way, they're saying holiday travel trends better than they thought they were going to be. So that's a big deal. Southwest Air, Delta Airlines, American Airlines, United Airlines among the S&P 500 airline stocks that are catching a bid because of that. So keep an eye on those airline stocks. And Kelly, I know you're going to be talking much more about that aircraft trade later on this show.
Indeed, Dom. Thank you very much. Our Dominic Chu. Well, has the drop in yields gone too far, too fast? The 10-year yield is down nearly a full percentage point since hitting a 16-year high. The TLT Treasury Bond ETF has surged 16% in less than 2 months. And in fact, November's 9.5% gain is its best month since the start of the pandemic. The ETF on track to post back-to-back positive months for only the second time in 2 years. But have investors gotten carried away with Fed rate cut hopes? Steve Leisman is here with a closer look. Steve?
Hey, Kelly, yeah, just weeks after that 10-year hit 5% and markets worried, could the government fund its deficit? Bonds have rallied and yields have fallen in what has been the biggest bond boom of the year. The opposite of what happened several weeks ago. The yield on the 10-year has fallen 87 basis points since in mid-October touched near 5%. And 37 of those 87, they've come just since Thanksgiving, which wasn't all that long ago. What's at play here? Well, better inflation data, including that decline in oil that Don was talking about, repricing of the Fed and Fed rate cuts. We'll talk more about that in a second. Hedge funds covering shorts. Everybody was sure was going higher. They were wrong. Then pension funds and insurance companies come in to lock in those longer rates, driven in part by the growing belief the Fed is done hiking and is going to cut. Take a look at that. In mid-October, the market was priced for about 70 basis points of cuts this year. That has nearly doubled, with 134 basis points of cuts now built into the futures markets, beginning, by the way, as soon as the March meeting. Rick Reeder, though, from BlackRock, he tells me, I think the front end is over its skis. I don't think they're going to ease in March, so that's something to think about. Here's something else to think about. Markets are going to watch carefully another round of massive Treasury auctions next week after poor auction results led to stock sell-offs a few months ago. 3- and 6-month bills, $143 billion. You got your 3-year notes, your 10-year notes, your 30-year bonds. Wait for Santelli's grade on those. That's going to be important. For now, it seems lower inflation, hedge fund short covering, and a belief in deep rate cuts by the Fed next year is going to calm fears about how the government funds the $33 trillion deficit. But tomorrow's jobs number, if it comes in strong, could challenge the rate cut hypothesis and enthusiasm. And some also expect, Kelly, Fed Chair Jay Powell next week to push back on the rate cut pricing, which has fueled this bond rally.
So we have those bond auctions next week, and we're going to hear from him, Steve.
Says Iraq's decision comes within framework of joint efforts.
All in 1 week. All in one package. You got your jobs report tomorrow. So don't go anywhere, because you got to keep CNBC on here. You got jobs tomorrow. You got 3 big bond auctions next week, and you got Fed Chair Jay Powell. And don't forget the CNBC Fed survey comes on Tuesday.
That's on the calendar, too. Steve, stay with us. We appreciate it as we debate where bonds could go from here. One of my next guests warns that yields will shoot higher next year. Let's bring in Jim Bianco, president of Bianco Research, and Nancy Tangler. She's here on set with me, and she's CEO and Chief Investment Officer of Laffer Tangler Investments. Welcome to everybody. Jim, you can just tee things off here with what's becoming what was a consensus call maybe a month ago and suddenly is out of consensus. But you're sticking with this idea that bond yields could yet go higher.
Yeah, I've been that way for 3 years, and I don't think that the move that we've had right now is over. I actually think we're in a multi-year bear market in bonds. It started in 2020. Usually, you get a recession or a serious downturn in the economy because something breaks. Either it's spiking crude oil prices or a pandemic or a financial crisis or something like that. This time around, everybody thinks the thing that's going to break the economy is high rates. But more and more, the evidence is high rates are a drag on the economy. They're not, helpful in some areas, but they are helpful in other areas because of interest income, and I don't think it breaks it. So I think what we're going to see for the economy for 24 is what we saw in 23. We'll churn out 2%, 2.5% quarters like we have been. I don't think inflation makes it all the way to 2%. We're going to have strong nominal growth, and I think that bond yields can probably see 5.5% somewhere in 2024. So the move down so far has been surprising and painful if you've been on the bear side like I have, but I still think the broader trend is still higher for rates.
Nancy, it's one of these things with the macro where you could almost completely ignore it, except for all of the extremes that we've been through. Even the bond move has been dizzying for a lot of investors. Where does it leave you kind of positioned into next year?
Well, I certainly agree with Jim's view in 2020. We argued then that bonds were riskier than stocks. But now I'm drawing an analogy to the 1990s when I was not only alive, but I was managing other people's money. And there's a lot of similarities. And you don't really need to see rates go lower. We were at 5 to 8% on the 10-year during the entire decade.
Wow.
We don't need to see inflation go back to 2%. And I agree with Jim. I don't think it will. We were at 3%. There was an inverted yield curve, a soft landing, a war, a recession. I mean, there was just everything that you needed. And one of the most important things was the VIX stayed under 18 for most of the decade while the stock market roared. So I think we're slowing. I don't know that we're going to get a recession, but I want to own those reliable growers going into a slowing economic environment.
I was reading some trader commentary this morning, and the tech traders kind of have their head in their hands. Now, maybe today a little bit different story, but we haven't really seen the performance from the Mag 7, for instance, that we were able to rely on. Does that affect you that much, or is that some take it as a healthy sign into next year?
I think it's both. I think you want to use the weakness, the recent weakness, and if we get further weakness to add to those names, because the generative AI total addressable market, I just gave a presentation on the fourth industrial revolution. You need to own these stocks in your portfolio. If the market broadens out, I mean, that's good for every portfolio manager because we have to be diversified. So I think our theme is old economy companies that are embracing the digital revolution, generative AI, cloud computing, and then the suppliers of the tools you need to get there.
But you're sticking with Microsoft, you're sticking with Adobe, you're sticking with Broadcom, names like that.
Yeah, well, Broadcom's reporting today, so I'm going to hedge myself. If it goes up, it's one of our largest holdings. If it goes down, you want to buy more. It's the poor man's Nvidia, and I think you want to own that stock.
Well, Jim, let me turn back to this discussion about bond yields, because in one of the things you described is that you're in this no landing camp. And certainly this year, the recession never came. There were times we had the June rise in jobless claims that made it look imminent, and then that went away. We do have this rise in the unemployment rate, but if tomorrow is really strong, maybe that goes away. So how important is that we just have a continually expanding economy in order for us to get, bonds behaving like you describe?
Well, I think that's central to the whole argument here is that the no landing camp is just an expansion. We just continue to expand on the economy. It's not the soft landing camp. I've been critical of soft landings because it doesn't have a definition. I don't know what exactly it means. And you could actually argue we've never, ever had one, a soft landing. So if labor continues to show the strength that it has, 220,000 initial claims today is historically a very low number. We're still under 4% on the unemployment rate. Then I think it really does augur this argument that the labor market is healthy. I think a lot of employees feel good about the labor market. That's why we've seen labor hoarding and we've seen a lot of turnover. The quits rate is still very elevated from where it was pre-pandemic, meaning people are willing to quit their job and take another job or quit their job because they're comfortable they're going to get employed. And if they're comfortable they're going to get employed, they keep spending. So I know we've always focused on excess savings, but I really think it's more about labor confidence that's got the spending going. And that's why the economy confounds everybody by never quite making it to a recession, even though it kind of bounces around.
So I agree with a lot of what Jim has said, and I think Jim is bringing a sort of economic view to the discussion that's sorely lacking among many people, which is that, hey, if the government's going to spend all this money on debt, it's going to be giving the money to somebody, and that money gets back into the economy. The other thing I think that Jim does well is this notion that everybody's been focused on this savings thing, and nobody's really been focused on the idea that so many people are employed and bringing home paychecks as central to the outcome. The only thing I'd push back a little bit on, Jim, when I think about 5.5% on the 10-year, now maybe you're saying it just gets there. I'm just not sure if we end up being in an environment of, say, steady inflation in the 2 to 2.5% range, not 100% sure why you would have long bonds at 5.5%. Maybe that's a long-term cost of funds or a real rate. Or are you saying, Jim, I guess my question is, that there's still an issue with the government funding this enormous amount of debt for which investors are requiring a premium in order to fund it?
A little bit of all of the above. The way I arrive at 5.5% is I think we're going to be at like 2.5% on real growth. That's what we were in 23, continuing into 24. I'm a little bit more hawkish on inflation. I think that the bottom on inflation is around 3%. I'm talking core. Core's at 4 now. It bottoms somewhere around 3. Add those two together and you're a little bit above 5. That's nominal GDP growth. That's inflation plus real. Typically, interest rates should trade around the nominal GDP level. And yes, I'm going to put a little bit of a premium on it because of the big budget deficits and the amount of funding that we have to do. And that's how I arrive at 5.5%. Now, if the economy's weaker than I think, if inflation's weaker than I think, or the budget deficit or tax receipts come in stronger, I'll adjust it along the way. But right now, I feel very confident in that number.
Does that, real quickly, Jim, not that we usually talk to you about your equity calls, but I mean, you are constructive on the economy, so does that leave you also bullish on stocks?
To a point. And the point is, I think people have to recognize, Dr. Jeremy Siegel wrote a book, Stocks for the Long Run. He put out a new edition this year. Summarize it, the long-term prospect for stocks is around 8%. If I could get 5 in a money market fund, I'm getting 2/3 of the stock market with no market risk. What is it going to take me to take that final leap for that final third? This is far different to 2019 when I was getting 0 in a money market fund. I think the competition of higher rates is going to continue to be a problem for the stock market. That's why I'm in favor of stock picking. I think that's coming back into vogue now. Peter Lynch can come out of retirement because we're no longer going to be picking broad-based ETFs. We're going to be picking individual stocks.
Well, except that he would be coming out of retirement for 20 years based on how often we've heard that it's going to be the year that matters. I'll give you the last word, Nancy.
Oh, listen, I think the job market has started to show weakness. I also think the consumer is strong because most people are working, but also they spend out of their net worth. And the baby boomer generation has half of the nation's net worth. They are still spending. That said, we are seeing some cracks in labor. I think we're going to continue to see industrials kind of bottom out here with the PMIs. And then I think you have an opportunity for a really strong market. So I would disagree with Jim on that. I do think you want to own stocks here, even with a 5% money market rate, if he's right.
Or even with a weak, cracks in the economy that you describe. Isn't that usually the time to get a little cautious?
It is, but I think we're in a different, everything about this whole cycle has been different. And so we are working off of the pandemic excesses. And I think you have to step back. And it is a stock picker's market for sure, which is why I think you want to be focused on technology. I think you want to own industrials overweight because they tend to do well as the PMIs are bottoming. And then I think you have to just pick great names within each of the other sectors. Based on our theme, we're buying companies that are using digitization to improve margins, generative AI to improve product development. And so that's where we're making our bets.
All right. McDonald's, Domino's. everywhere I look lately, these are examples of the ones trying to adopt it. We'll leave it there. Thank you all today. We appreciate it. Nancy Tangler, Jim Bianco, and our own Steve Leisman. Now to the labor market. On the eve of tomorrow's big jobs report, we learned this morning new jobless claims remain at levels consistent with a strong number. The 4-week moving average on continuing claims, its highest level level in 2 years, but it also retreated somewhat last week. So is the labor market still going strong? Let's ask Recruiter.com Chairman Evan Sohn. Evan, you know, in some ways, the trend from a 30,000-foot point of view should seem obvious. The labor market is slowing, and yet it seems it's not slowing enough that it really is making that much of a difference right now.
Real-time service.
Yeah, well, good to see you again. Look, I think the segment you just had talked about candidate sentiment, and we saw the same thing. For the second month in a row, the candidate sentiment increased to 3.5 out of 5. So a year ago it was at 3.7. So that means that candidates are feeling okay leaving one job for another. At the same time, recruiter sentiment is down to 2.7 out of 5, a low on the recruiter sentiment, a sort of this leading indicator for where things are actually happening. So and we also saw from the Joel report about 8% fewer job openings. So there are fewer job openings. There's more volume, as you just showed, for those fewer jobs, with less compensation. Compensation is not increasing as much as it was certainly a year ago. So that's making the recruiters really their sentiment be at an all-time low relative to the overall year. But as you just said in the last segment, you're seeing a very consistent quit rate that's higher than pre-pandemic levels and a hire rate that's also consistent.
Interesting. So this is a bit of a divergence or something new. Recruiter sentiment, lowest of the year, 2.7 out of 5. A serious decrease in open jobs driving an increase in application volume. So more work for fewer open jobs. And interestingly, also point out, only 11% of them saw an increase in compensation.
That's right. So this the days of hire at any cost and just get people and get people fill the seats, that's over. Yet, as we just learned, candidates still are comfortable leaving their jobs. So they're comfortable they could find a job. They're more comfortable than they were in the past, but it's at a less of a compensation level.
Yeah. What does this point to you then? And again, the kind of the pay and trade tomorrow, I think, is a strong number, right? That kind of upends what's been going on with bonds, sends yields higher again, and all the rest of it. But if we stay on trend, then it sounds like the trend is that we've been slowing.
That's correct. And you look at, in the Aura report, we talked about this last month, the Aura report on job trends, the top industries were actually staffing and recruiting. So that's a good sign for the future. When companies start hiring more recruiters, they're looking for the future. But you start to see downturns in other sectors like computer and in the software side. And I saw you talked about AI in the last session also. And obviously, healthcare has always been a very strong sector as well. We saw a 70% increase, almost 70% increase in AI-related jobs in the financial sector, month over month. So more jobs in the financial sector looking at AI, and that's not just customer support, but it's customer support, it's analysis, it's regulations, it's really across an entire financial services portfolio. And that might be pointing to, as we've talked about, sort of this rolling layoff side, these rolling layoffs, financial services might see more of those sometime in 24 as the benefits of AI affect the overall labor market, obviously lowering OpEx as well.
We'll hear a lot more about that, I imagine. It would be interesting to get the CEO's take as well, kind of talk to us a little bit about what they're doing and what they're seeing. Evan, thanks for your time. We appreciate it.
Thanks so much, Kelly. Have a great day.
Evan Sohn, Recruiter.com's chairman. And coming up, airline stocks have had a mixed few quarters, but there's one company uniquely positioned to take advantage of the rebound in air travel, and its stock is flying at an all-time high. The CEO of AerCap joins us next. Plus, we are talking homes for the holidays, and the Street's #1 home building analyst for 8 years running says one very specific set of stocks are best positioned into 2024. Evercore's Stephen Kim is here to make his case. As we go to break, here's a glance at the markets, which are pretty much near session highs. The Dow up 90, the S&P up 0.75%, so the Dow's the laggard, and the NASDAQ up 1.3% today, 10-year yield right around 411. We're back after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. As airlines try to add capacity to keep up with demand, air leasing company AerCap is uniquely positioned to take advantage of the rebound in travel and the lack of aircraft supply. And it's pushing the stock toward a new all-time high. Phil LeBeau joins us now with the CEO of AerCap, Gus Kelly. Phil and Gus, welcome.
Thank you, Kelly. Gus, I appreciate you joining us today. I'm curious, you heard Kelly set up there, and you're seeing what's happening in terms of demand around the world. What's your take as you look into 2024, especially when it comes to international travel?
Phil, it's good to be on. It's pretty robust all around the world. When it comes to international traffic out of the U.S., the biggest market in the world, the most lucrative, is the North Atlantic market. And that's still booming. We don't see that changing. But Phil, a real driver of airline profitability for the medium term is going to be the supply environment. The worst enemy of the airlines is too many seats chasing too few passengers. And so long as we have more passengers than we have seats, things are going to be fine. And the issues that the industry faces because of the production problems with Boeing, with Airbus, and then the durability of the airplanes when they get into service is, in my view, going to result in supply shortages for the rest of the decade.
You think the rest of this decade we see a supply shortage, even as we start to gradually see an increase in production from Boeing and from Airbus?
Well, Phil, they will produce more aircraft. Now, since 2018, if you just took 2018 as the regular way production level of Boeing and Airbus, we're almost 3,000 aircraft light of that over what they've managed to produce in the last 5 years. So if they had kept 2018 production levels throughout the last 5 years, there'd be 3,000 more aircraft in the world. Bear in mind, Boeing and Airbus will only make about 1,200 aircraft a year. So even when they do get back to those levels of production, the challenge that faces the industry is the technology of these aircraft. The aircraft and the engines just do not... Say that again, Phil?
I'm sorry to interrupt you there, Angus. Are you comfortable with that technology? Or are you saying, even as you see advancements in things like fuel efficiency and lower emissions, the technology is just not developing fast enough?
It's not durable enough, Phil. It will get better. But the problem is, when the engines come off wing faster than anyone expected, the network isn't there to repair these engines. The parts aren't there to repair them. The spare engines aren't there. So at a simple level, historically you might have needed 10 aircraft to fly a certain route. Now you need 11. And in AerCap's position, we are the largest owner of aircraft in the world by a country mile, to be honest. We're the largest owner of spare engines in the world. And we've seen significant increases in aircraft values, lease rates. And the way the airlines are reacting, Phil, is what they're doing is they're saying to me, we need to hold on to these older aircraft for much longer than we ever thought, because we cannot rely on the durability of the new technology assets. And it's going to be a long time before Boeing and Airbus get back to the levels of production they want. So we see that lasting, as I said, for the best part of the rest of this decade.
That's fascinating, Gus. If I can just jump in and ask you one question, maybe it's relevant, maybe it's not. You know, we are in the middle of finding out what's going to happen with the JetBlue Spirit merger, Hawaiian and Alaska. How does do you have a kind of a take on the consolidation? Does it overall lead to more demand for planes or less?
Yeah, I don't think it'll move demand for aircraft much, but I think it'll make the airlines stronger. Airlines are so capital intensive, such massive operating leverage that scale is vital. And if you're subscale airlines, it's hard to compete with the really big players in the industry. So that'd be what I'd say more, Kelly, is that I think the benefits of the merger to the consumer are that there is more staying power. There's airlines that can compete with the four incumbents here in the U.S. market at any rate.
Gus, I'm curious from your perspective and what are you hearing from your customers when it comes to the Pratt & Whitney geared turbofan engine issues as Pratt & Whitney tries to work through that. A number of these engines have come off the plane. They got to be repaired, but it's going to take some time. How much is that impacting your customers in terms of their networks and their operations?
Phil, there are significant impacts. So first of all, you're going to have a lot of aircraft on the ground next year. These are expensive machines, $60 million machines, pilot costs, a lot of fixed costs in the airline around those aircraft. And they're not going to get delivery of the ones that they had expected to get. But from our perspective, what we see, the real solution here is that Pratt & Whitney, I believe, they will fix this issue, but it's going to take a long time. And it's going to be a bumpy ride. So what needs to happen for the airlines in the next few years is that Airbus and Pratt & Whitney have to sit down and say, we are just not going to be able to deliver as many airplanes as you want, Airbus. That just isn't going to happen because the airlines, they don't need another aircraft. If they have a $60 million machine sitting on the runway because the engine doesn't work, what they need is a spare engine. They need the engine that's on the wing repaired. All of this will get done in time, Phil, and everybody in the industry just has to step back, be it the owners of the aircraft like AerCap, the manufacturers like Airbus, the airlines, and the engine guys, and say, what's best for the long-term health of our customers? And that's going to require Airbus and Pratt to sit down and say, we need to come to an arrangement where we can manage the situation for our customers. Because just telling the customer you got to buy another $60 million aircraft, another one, it's not going to end well for the customers. So that's the biggest challenge over the course of the next few years. And Pratt will get there, but it's going to take a long time. It'll take a year just to repair one of these engines. So that means that the aircraft's on the ground for a very long time, unless they can get access to spare engines or parts. And we're doing our best to help. As I said, we're extending aircraft with airlines. We're selling aircraft to airlines. Just this year alone, we will probably buy, sell, or lease 1,000 aircraft engines and helicopters. And Boeing and Airbus only produce 700 assets. So that gives you an idea of the level of insight we have to what's happening every day in the global industry.
Hey, Gus, I hate to cut you off, but I'm being told we're getting pushed up against a break. We're going to be watching this next year, and I know we'll be talking more. Gus Kelly, the CEO of AerCap, appreciate you joining us today and for some perspective on what's happening with commercial airplanes. Kelly, I'll send it back to you.
That was fascinating. Gus and Phil, please come back anytime. Super interesting to hear his candid take on what's going on with those engine problems and more. We appreciate it. Coming up, this retailer is having an unbelievable 3-week streak with only one down day in that time. The CEO taking a page out of Bob Iger's playbook, returning to the company after retiring, although they do face growing competition from China. If you think you know this one, tweet me at KellyCNBC. We'll reveal it after the break. Welcome back. It's time for Show and Tell, where we show you a chart and tell the story. Dollar General was the mystery chart we showed you before the break, moving fractionally lower after beating earnings estimates and reiterating its full-year guidance. But the shares are up more than 15% in the past 3 weeks, with only one down day in that time. Here's what Todd Vasos, who just came out of retirement to return as CEO, said on the earnings call about the state of the consumer.
Our customer continues to tell us they are feeling significant pressure on their spending, which is supported by what we see in their behavior. Based on these trends and what we see in the macroeconomic environment, we anticipate customer spending may continue to be constrained as we head into 2024, especially in discretionary categories.
And those macro pressures aren't the only thing investors may be worried about. New data shows a surge in sales at Chinese e-commerce giants Shein and Temu is even creating some welcome havoc in the air cargo market. Fully loaded planes, it means more competition for Dollar General in an already tight retail environment. Let's get to Tyler Matheson now for the CNBC News Update. Tyler?
Kelly, thank you very much. Donald Trump is appealing a judge ruling that he said he is not immune from criminal prosecution in his D.C. election obstruction case. Trump's legal team argues that the former president cannot face criminal charges because his actions fell under presidential duties. The appeal contends the federal criminal case should end altogether and that upcoming deadlines should be delayed, including the March 4 trial date. Georgia state lawmakers gave final passage to a redrawn congressional map and are sending it to a judge for approval. The new version adds the court-ordered black majority district, but still maintains a 9-5 edge for Republicans in the state. The map is expected to be signed by Governor Brian Kemp, but is likely to end up right back in federal court. Meantime, opposition activists in Russia are putting up billboards urging citizens to vote against President Vladimir Putin in next year's election. The billboards are disguised
Be careful
as
of a roll
New Year's
here.
greeting with
You're
a
getting a
QR
roll here.
code that leads to
High
a
probability
website
of a roll here.
called
Be
Russia
very
Without
careful.
Putin. The anti-corruption
It's 1:30 in the
Foundation,
afternoon.
founded
This
by
is
the
when
imprisoned
manipulation
leader,
comes into the market.
Alexei
I'm
Navalny,
going to give you guys a
paid
warning
for
right here.
billboards in major
Middle of the afternoon, we're coming into the 1:30 hour where we get manipulation. Be very careful. Couldn't make a new high. We're likely going to roll down and test that half hour and hourly trigger right now. So be very careful. If you are long here and say, fuck you, Cap, we're going to squeeze up, Cap, you're wrong. At least have some stops or a plan in case it does roll down on you. If you ain't a badass, you have no business trading this right now. It'll be fast, up and down, so be very careful here. As a matter of fact, right where you are and how this looks to me right now, you see how you've got like vertical white line right there, vertical white line right there. You got, not as much, right? Not as much, right? Flattening. It's still neutral, right? If I was a bull right now, I would be waiting for that move first and then jump here on that trade right there. Get it? I would not be long here. Does that make sense? If you're a bear, you want to see the break and then the rejection. Like you want to see, if you're a bear and you want to trade this, you're looking I would not jump on this with puts either. Would not jump on this with puts. You want to see, if you're a bear, you want to see the first breaking bar, right? You want to see the failure by bulls to recapture. So you want to see this green bar fail like right there, and you're Johnny on the spot with puts or a short only here. Only right there, okay? If you're a quick bull, you can wait for a break, and you'd be buying this, but you might get trapped in here, right? So you'd be ping-ponging in here. So you could trade just this as a bull. If it breaks above, you'd then come back in on the bounce to take this to the upside. So it's very complicated trading this right now. Make sure that you're a great fucking trader, that you understand the mechanics of how this works. And bulls are still holding it here. There's no bearishness here yet. You need to see the break below to take that stab trade straight down here. Okay, if you are bullish and you're long already, or like already trapped, put some stops in, or note that if it reverses on you, you'll be given a chance to get back out again right here before the drop. Make sure you get managing your trades out there right now. Very saucy right here. Very saucy. Very tricky right here. I love these trades, but make sure you understand the mechanics of it. Yeah, I saw the end short blow up. I saw the end short blow up.
Welcome back. Shares of Alphabet now up 5% today, having a delayed reaction to the launch of their Gemini AI model yesterday. Let's get out to Deirdre Bosa for more on today's Tech Check. Deirdre, come on, in this day and age, a 24-hour, and we talked about this yesterday. You showed us the tape.
Yes.
And here we are 24 hours later, and everyone's like, wow.
I know. I could barely believe my eyes yesterday, especially after watching that 6-minute video. I thought, this is amazing. Why isn't the market recognizing this? But it was just delayed. So the stock didn't do anything yesterday, but it was up today at one point, some 6% for a very, very large cap company. So very strong reaction. And maybe that tells us that the AI halo is still very much present, which we started to doubt yesterday, and that Google has now won an edge in this AI arms race that we've been watching all year. Now, what Kelly said, you really have to see and hear Gemini's technology and the latest developments in generative AI to really understand the impact that it could have. So I'm bringing you another example from that Google presentation. Have a look.
I know what you're doing. You're playing rock, paper, scissors.
What do you see now?
The fingers are spread out to look like the wings of a butterfly.
What's this?
Big ear and barking mouth, a dog.
If that didn't kind of amaze you, here's one more example.
What movie are they acting out here?
I think they are acting out the famous bullet time scene from The Matrix.
Now, I highly recommend the entire 6-minute video. Other examples include Gemini understanding colors, 3D objects. It creates games and even cracks jokes. Now, the word to describe this next evolution in AI is multimodal. That means it incorporates audio, video, images, and you're going to hear that word a lot more, Kelly. So I'm keeping this short and simple and hoping that video speaks for itself. Again, maybe part of the reason it was more subdued yesterday is that this is being rolled out in phases, and it does kind of feel like it was rushed. Google doesn't often have events between Thanksgiving and Christmas, and the most powerful version won't be available widely until next year. So that could be part of it as well. But clearly, some pretty interesting demonstrations there.
Maybe if we wait a day, then the shares will be down. And then oh, wait, but not yet part of this. Deirdre, for now, thanks. We appreciate it. Our Deirdre Bosa out west. Still ahead, 3 more names on deck with earnings. And my next guest says one of them is setting up for gains post-report based on one recent trend she's noticed. We've got the trades for Broadcom, Lulu, and Vail Resorts after this.
Broadcom.
Welcome back. Semis, sweats, and snow are the subjects of today's earnings exchange. Marianne Montaigne is here with our trades. She's Gradient Investments Portfolio Manager. Marianne, welcome back to you. Let's start with Broadcom. I feel like it's an audience favorite. Coming off all-time highs near the end of November, when that acquisition of VMware closed, Oppenheimer says the deal should add $15 billion to top-line growth each year, along with AI and hardware partnerships with Apple and Google supporting their bullish call. You like the stock here?
I do. First of all, though, I have to say happy holidays to everybody.
Thank you.
And I'm wishing everyone light and peace. Now, as to Broadcom, this stock has performed very well. It's up 45% over the last 2 years. What AMD had to say yesterday about AI and cloud computing is only positive for Broadcom. We expect that those synergies coming out of the VMware acquisition will be very powerful, and we expect management to talk about them today to put some numbers around that. So we still think there's mid-teens upside in this name with a 2% dividend yield.
All right, let's move on to Lululemon then. Just off that 52-week high, Ray J watching the higher-end consumer, saying growth in China, men's, and promotional activity should all combat some of the softness in the luxury space or the aspirational space. Would you stick with this one?
I would. You know, they had about 12% same-store sales growth last quarter. Compare that to minus 5+% out of Target. And we think that it's strongly driven by China, where sales were up 60% last quarter, 6-0.
Wow.
We think that there's been some short selling in the month of November, and we think the stock will pop on today's report.
All right, going ahead with a bold call on earnings. I love it. Okay, Vail Resorts is our last one, down for the year. Stifel pointing to their Epic Pass program and some new acquisitions as a potential catalyst. It's a supply-constrained business. There's no new mountains. But they also think skiers are recession resilient. You agree?
Well, I'm not so sure about recession resilient. That's like being a little bit pregnant. But talk about the sales of preseason sales, that is, of passes, annual passes. Those were very strong. They were up about 11% in dollars. And also you see a 15 to 20% increase in seats from airlines going to their properties. So I think combine that with unfavorable weather conditions last year, and you've got a few tailwinds going on here. Also a more normalized labor market and other efficiencies.
Yeah.
And there's a front range passenger rail that just got approval from the federal government that should help bring people over the longer term. We haven't been buyers of this. It's been a pretty bad performer in recent months. But we're interested in watching for the results today.
Right.
With a 3.85% dividend yield, I think it's worth watching.
In a bullish mood today, Marianne, we'll let you go. Thank you so much for your time, Marianne Montaigne. That does it for the exchange, everybody. Power Lunch is next. Tyler and I will join you on the other side of this break.
Call us and find out.
Welcome and good afternoon, everybody. Welcome to Power Lunch alongside Kelly Evans. I'm Tyler Matheson. Coming up, we're getting ready for the jobs report tomorrow. Some signs this week that the jobs market may be starting to cool just a bit. So what to expect tomorrow and what it could mean, Kelly, for the markets.
Plus, some big CEOs on CNBC in the past 24 hours. We'll hear highlights from AMD's Lisa Su, Amazon's Andy Jassy, and Exxon's Darren Woods. And we'll get our traders' take on those stocks coming up in 3-Stock Lunch. First, let's get a check on the markets, though, where you can see the Dow close to session highs, up 88 points today, and it's the laggard. The S&P up 0.8 to 45.86, and the Nasdaq surging 1.3%. Kind of calm bond yields are helping the 10-year around 4.11 last check. And shares of Walgreens Boots are leading the Dow, up 7%, on track for their best day since March of 2020. The stock is still down nearly 40% this year, though, its worst year ever. And that's given the stock a very attractive 8% dividend yield. You can see it higher, in fact, even than the stock move today.
And the big drug companies are mostly lower today. The White House once again targeting drug outfits, saying big pharma makes record profits while Americans struggle to afford the drugs they need. Let's bring in Bertha Coombs to explain exactly what the Biden administration is proposing.
Yeah, in some ways, it's like doubling down on the Inflation Reduction Act, the price negotiation part of that. The Biden administration is asserting the right of the government to seize drug patents of high-priced drugs that were developed with taxpayer funding. Now, the 1980 Bayh-Dole Act paved the way for universities and small companies to commercialize discoveries made with federal funding, from cell gene therapies and medical technology to things like Google and some quantum computing. Now the White House aims to use the march-in provision of that law to take on high drug prices. Cancer patients have repeatedly petitioned the government to use that march-in provision on Astellas' Xtandi. That's a prostate cancer treatment with a list price of more than $150,000. The government has repeatedly refused. They say they should allow others to produce it to bring more competition. While the bipartisan law allows march-in when a patent is allowed to lay dormant, it's never been used to break a drug patent on the basis of price. Senator Elizabeth Warren applauds the move, saying it's time to use that tool to bring down costs.
When there's no competition in a market, then that falls hard on people who need that drug. It also falls hard on taxpayers who end up paying for it through other government programs. And march-in has been in the law for a long time.
Pharma, the pharmaceutical industry group, well, basically, they argue that march-in was never intended to be a government price-setting policy, and to do so will set back research by more than 40 years.
So how would this march-in work in a practical case? In other words, there is a drug that was developed in part with federal money, is now being sold at a very high, some would say, unattainable price for consumers. The government would march in and say, what? Unless you lower the price to X, we are going to take the patent rights of that drug and collect the profits from it. How does it work?
Ostensibly, that's how they would work. They didn't give an exact example of that. But, you know, I was joking with you earlier, that this is going to be the full Lawsuit Employment Act. There's certainly going to be litigation on this because you have patent law that works. And
have they decided to do it, or have they decided to think about doing it?
They have proposed this. They're going to take comments on this and then issue the final rule later. You know, at the moment, it's really about just communicating that they are looking at every way possible to reduce drug prices.
Very, very interesting in the pre-political year, obviously.
Indeed.
Lowering drug prices is a very potent political issue. Bertha Coombs, thank you. All right, let's turn now to the potential companies that could become targets of this new plan and discuss whether the government can really enforce those march-in rights. Joining us now, Jared Holtz, healthcare equity strategist at Mizuho, and Evan Siegerman, biotech analyst at BMO Capital Markets. Welcome to both of you. Jared, let me start with you. I think I just described sort of the process that could be at work here. And on the one hand, you would say, well, how could the government get away with doing that, coming in and asserting that we're going to take over this patent, or if that's what they're saying they're going to do, unless you lower the price? On the other hand, there is a sympathetic side to this that says, well, hell, If I, the taxpayer, have paid to develop this medicine, paid a lot of money, if my tax money has gone to that, and now the pharmaceutical company is charging $140,000 for a treatment of a prostate cancer drug, that doesn't feel right to me. And they get to keep all the profits? I'm getting stiffed at both ends.
Tyler, thanks for having me. I appreciate it. I think this is a little bit of a slippery slope, obviously, for large cap pharma and biotech. These march-in rights, though, you know, on the positive end of the spectrum, are not really limited to this one sector. I think it's much broader. It's going to go into the technology industry and many others.
Technology,
in which the
defense, whatever. Yeah, sure.
So it's much broader in scale than just this one industry group, you know, which I think is good, because we're always talking about how pharma seems to be the target of the government every other week. You know, as I look across, you know, the space with respect to large cap pharmaceuticals and biotech, not really sure that there are that many drugs that have been co-founded or co-developed with material government funding. And if that's right, maybe the list of drugs that the government is going to go after in this case in order to secure the patents back is not going to be so vast. And if that's true, you know, maybe this is not a huge issue, but to Bertha's point earlier, it obviously adds onto the IRA. And from a political standpoint, it's clear where the government's at here.
Evan, let me ask you, is this essentially, and Jared just said it seems pretty political to him, is this essentially political theater that's going on here, number one? And number two, it would occur to me that one of the targets here, or a possible one, would be Pfizer and Moderna, whose COVID vaccines were heavily financed by the taxpayer.
Well, there's a few questions there. First of all, as a political theater, we are heading into an election year, so I'm sure there's some more posturing around drug pricing. Biden got the win against the pharma sector with the IRA, and this is kind of continuing that theme. In terms of Pfizer and Moderna, I think, you know, Pfizer, I don't know if they actually took much funding up front. It was just some pre-funded contracts. But really, you know, the NIH does have a role in helping see these technologies, but these pharmaceutical companies put up billions of dollars at risk to actually develop the drugs. You don't want the NIH developing drugs. They'll never get anything done.
Evan, who's most at risk in terms of potential research and development? Maybe there's some companies that come to mind, maybe biotechs, broadly speaking, maybe, you know, kind of how would you be thinking through this as an investor?
Well, if this were to actually happen, I think the entire sector could be at risk, because who knows at what level the NIH or kind of the march-in rights would apply. Would it be some early technology like the basis of mRNA for the vaccines? Would it be part of an antibody drug conjugate? So it could be widely applicable, probably in the specialty therapeutic space. So think cancer drug manufacturers, inflammation drug manufacturers. So maybe AbbVie, potentially Merck, Bristol.
And so what should those companies then do? You know, what is anyone going to do other than kind of wait for more details? And would we expect the Supreme Court to get involved at some point, or no?
I mean, I don't know if the Supreme Court gets involved, but I'm sure if this went through, there would be several lawsuits. I think the companies need to keep doing what they're doing. This is only a proposal. This isn't actually necessarily going to happen, but it really takes into account whether or not, you know, these companies want to use the NIH and kind of funding and research from the NIH to help, you know, bring forward some of their R&D efforts. They may kind of choose not to use that, do their own stuff internally, and take them out completely, which would be a shame, because there's a lot of good research coming out of the NIH.
Jared, are there companies that you follow that you think would be more vulnerable to this should it happen?
Well, you mentioned Pfizer and Moderna earlier. I think those are two that come to mind right away, given the vaccine funding over the past several years for COVID. Really have to go and look and do the work on the discrete line items, company by company, to see, you know, where the NIH has been funding. But I really don't expect it to be overly material. You know, my view at this point is it's more of a storyline, another negative narrative to add to the IRA in front of an election year, which is already possibly confounding and complicating a sector that has been, you know, not the best, to say the least, over the past year or so.
Yeah, indeed. And Jared, just to put a point on it then, does this make it uninvestable for 2024 until we get some clarity?
It seems like pharma is as out of favor as it's been as a category, obviously, other than a couple that have been involved in the obesity space that we've spoken about at length all year. You know, the multiples are very low at multi-year lows. The stock prices are at multi-year lows. So I'm really not sure what takes the category higher other than, a value trade, which is, goes across industry groups. Hopefully at some point that this narrative quiets down. But given the fact that the Democrats seem hell-bent on, introducing new complexities into the sector, and then you've got the GOP on the other hand that has been, fairly active in terms of, how they've been politicizing the companies. It seems like the setup is not easy going into next
Jared, does the CVS, do the moves that they are making, maybe responding to cost-plus drugs and all the rest of it, in the prescription drug space, is that another headwind for this sector? Is it a tailwind if it finally, how should we be thinking through that as well real quickly?
I think we want visibility. I think the street wants to have some sort of clarity on how companies are making money, what the P&Ls are looking like, and how they're derived. And to me, that's a net positive, even if it means you might see a little bit of degradation in terms of earnings. The stocks are already trading so low. I feel like better visibility in this case might be a positive.
I think that makes a lot of sense. Gentlemen, thank you both. We appreciate it today. Jared Holtz and Evan Siegerman. And still to come, jobs report on deck tomorrow. Major Fed decision next week. Investors hoping the data could put an end to any future hikes. We'll get insight from the CEO of ZipRecruiter. Plus, some major CEOs sounding off on our network lately. Amazon's Jassy, ExxonMobil's Darren.
This is Sasudia.
Lisa Su will give you the highlights in 3 Stock Lunch coming up.
In-store and online.
Welcome back to Power Lunch, everybody, as we count down to the November jobs report. I know you're all doing this at home. It comes out tomorrow morning, in fact, at 8:30. Data this week show a cooler labor market. These are the sort of contextual numbers that we look at. Private payrolls up by 103,000, but that missed estimates for November, which were about 30,000 higher than that, if I'm recalling correctly. Initial jobless claims out today, little change, 220,000. Continuing claims did hit the highest level in 2 years. Despite these numbers, our next guest says we could be in for an upside surprise tomorrow. Ian Siegel is the CEO of ZipRecruiter, a leading online employment marketplace. Mr. Siegel, welcome. Good to have you with us. Why do you say an upside surprise tomorrow when some of the other numbers do tend to indicate a slightly cooler job market?
Well, to be very clear, if you look just at ZipRecruiter job posting data, what you will see is that it continues to decline, just like it has persistently declined for the last 18 months. We're all the way back to where we were pre-COVID, and we're continuing to fall from there. However, the end of the year is a really unpredictable time to predict what the BLS will say when it comes out with its jobs report, because there is so much seasonal hiring at this time of year. And often a single job posting can in fact be used to hire 100 or hundreds of individuals to fill a role for the next few months.
The seasonal hiring is, I guess, reasonably strong in retail, but maybe even stronger in service-oriented businesses, restaurants, hotels, et cetera.
Yeah, I think the real upside surprise that everyone is experiencing right now is that consumers continue to spend, and they're particularly interested in spending on experiences. So whether you're talking about restaurants or event venues or any sort of tourist opportunity, those are areas where a lot of money is still going into the economy. And as a result, businesses are forced to staff.
Do you see this as a time where the Federal Reserve needs to be mindful? They've had their focus has been sort of laser focus on keeping inflation down. Is now the time that they need to start glancing in the mirrors and seeing where the employment market is?
I mean, I'm going to say I sure hope so. If you look at where we are relative to a year ago, you've seen wages begin to flatten in new ZipRecruiter job postings. You see the number of new job postings that have a signing bonus as part of what they're offering down 25% from a year ago. In ZipRecruiter's surveys of our employers, they're telling us that over half of them have lowered the salary of at least one position that they're currently advertising for. So it definitely seems like the work the Fed has done has served its purpose. I think we'd all like to see interest rates stabilize and ultimately decline.
I think we know where the strongest sort of sectors are, like healthcare, education, tourism, hotels, restaurants, and so on and so forth. But I want to ask a different kind of question, and that is this. It is pretty clear
that we're not on a sustainable path to 2% inflation target.
And I do not include in the description of that job the option to spend some of the time remotely, how much of a disadvantage competitively am I putting myself in?
Do you want to stay up to date with the latest and be on the
I mean, a massive disadvantage. The world has fundamentally changed, and it's been long enough that I'm going to say this is forever now. So clearly, it's a hot topic to discuss whether or not we should compel people to go back to work. But the currently employed people are voting with their feet. And what you see is higher satisfaction amongst those who are working for companies that allow some sort of hybrid work style. You see that job postings that say they can be done remote get 3 times as many applicants as those that insist on an in-office work policy. Yeah. This is a sea change in what we have experienced over time. And if you even compare the number of job postings on ZipRecruiter today with a year ago, you'll see that there's 4 times as many job openings that offer either hybrid or fully remote work in the job description. Yeah. So this is working its way through our economy. Any advantage will be taken by employers.
Remote is key here. So Brian, Kareem, Nikki, you all can go home. You can work remotely. Okay, get on out of here. That sounds good. Ian Siegel, thank you very much. We appreciate your time.
Thanks for having me.
I just saw a sea of arms going.
They're out of here. They're all gone. But you got to stay. Mr. Jib has to, I mean, not Mr. Jib, Mr. Steadicam has to stay.
We're going into the capitulation phase here.
To be positive.
So if you don't notice or don't know, there is a bunch of capitulation happening right now. Be careful as this happens. It'll be very quick and fast. Let's take a look on the upside here. We're going to clear out a bunch of this supply up here. Oh, I can't. For some reason, this is stuck for me today, but hold on. Got three nice red bars up there. They're going to slam right into this capitulation. just know that there is supply up there. We're going to switch over really quick to a trigger screen here. And be sober about this, okay? Or you should be sober about this as we come up into this yellow bar right here. Let me get a closer look at it, make sure that I got this right. I don't want to fuck this up. Let's get right down in the dirty over here, right about there. And watch this capitulation as it takes place. I want you to remember that these are where known sellers are up here, okay? So as we come up in here, as you see this capitulation, we can get really violent, right? You just slam through, and they will try to sell back down on you. So there's someone that's short up in here. They're going to tell you there's not, but there is. There's a short up here, and they're going to be pissed off, okay? And then you got another group of sellers up in here, and they think they're fine, right? They're just like, yeah, fuck you, I sold up here. You let people say, oh, they closed already down here. That's not true. These are the known sellers up in here. So even if they closed, they're standing here ready to fucking rain rocks down on top of you. So as we come into this capitulation, we're going to squeeze up in here, right? And then they're going to try to knock you back down here and here. Just note that they are here. Also remember something else. I see some people on FinTwit claiming that we're going to 4,800 like today. I want you to know that as we come up here, the expectation for this week, clear as fucking day. I said that I've been saying this shit for 3-4 weeks. Like, I think it's been 3 weeks now. Expect that sideways movement. I want to make another comment about this, which is I went onto YouTube last night, and I want you to see this action right here, okay? I want to show you guys something here. I went on YouTube last night, right? And people were posting thumbnails on their videos showing this down move, right? And they were making it seem like this was collapse. In reality, we are range bound. I want you to be aware of that. We are range bound, whether you like it or not. So as we blast up here, right? As we blast up here, start squeezing up here, it's nothing for us to roll back down, right? And maybe even possibly take out this one up here and then roll back down and bloodbath into Wednesday of next week. So be sober in your trading. I want you to realize that as we come up in here that we are still range bound. Those people that were posting collapse videos with thumbnails, they made it seem like they were only showing like this side of the trade or this side of the chart or something, and it looked like, you know, doom and gloom on their thumbnails. In reality, we are range bound. We are tied to 4,600, and we have a floor down here that we know about, right? So just be aware that as we have these actions here, you're going to see people saying 4,800 right fucking now. It's not showing that. So just be aware of it. Look at like scale out a little bit here. No big deal for us to roll back down, right? Catch another bump down in here. You get your Friday close up here. You get what I'm saying too? And then you have your drop off into Tuesday or Wednesday. Now, if you are a short or someone that is interested in throwing on a put spread for next week, we're in the place for it. You might lose a few ticks up here. It might hold into Monday, but this is not a bad little area to start to hedge a position, okay? So listen to me closely right now. Just like yesterday in that close, right? And I'm trying to be sober and have a better picture of where we actually are. I'm not trying to sell you subscriptions on YouTube, right? Where I show all that doom. I want you to realize that, have a little bit better picture here, right? Squeeze this up, come back down, come down here, squeeze this up here, come back down over here, right? Get another one up in here into the close. There's a whole bunch of stuff that can happen in here. But as we come up here, you can be long call spreads, whatever you want to be, but or not call spreads, zero dates, whatever. But just be aware that there's a seller hiding up in here. He's hiding here, and he's hiding here, so that he can position himself into next week. Okay, so start thinking about that. If you're trying to put a hedge on, this is a nice place to put one on for, as we come up here, nice place to put a hedge on into next week. Starting to enter that zone, okay? Even if we're strong here, starting to enter that zone. You get some capitulation. We just traded up to 456.90. You just poked the bear. That's what you did. You see that reversal candle on a 1-minute chart? Probably, I don't know. I'm just saying, show it to you right now. So see this candle right here, this reversal candle. See that right there? You know what that is? That's a bear up there trying to poke on you right now and send you back down to the depths of hell. So just be aware of it. Note that people are going to position a hedge on the market into next week. It sucks to buy a hedge when it's like, you know, like I'm going to wait, and then it blasts down 30 points and you don't have a buffer any longer on your hedge. So just be hyper aware of it. And let me see if I can open that back up. Just be aware that this is a known place that sellers are going to step in and they're going to hedge some positioning here. Puts are cheap, dude. They're dirt fucking cheap. Get yourself some Wednesday fucking puts that are OTM right now for like 1, 2, 3, 4, 5 pennies. Just stack 100 of them and don't just forget about them. Put on an in the money put spread. Think about it where we are right now, right? Throw a put spread that's just in the money that expires on Wednesday. You'll capture all of that fucking. You'll capture all that theta burn. You'll likely have a down moment on Wednesday for the rate decision where you can actually have the opportunity to close. So a nice fat put spread in the money, right? You get that put spread, you throw it on there. You get a put spread. I don't know what you'd get it at here, but I'd get like 460 to 458. I bet you can make an easy 20% minimum on that trade, and you're just looking for a moment of volatility on Wednesday to close them down, right? It's like a softball. If you don't understand, it's like a softball trade. So right where we are, or if we continue to blast up and roll over, you should have that moment where you can add one right here or even add one up here.
So it seems likely they're taking in the data the same way we are.
So if you catch that roll, even if we squeeze later, we just catch that roll on a Wednesday, and shazam, cha-ching, you made a bunch of cash down here, right? Ring the fucking register. No-brainer trade. Fucking softball. That's what it is, a fucking softball. just zone out a little bit here, right? Like, hold on, just like remember that we are range bound, okay? Don't get too crazy. And I wouldn't get too crazy as a bear here. Don't be like out there fucking buying like don't be out there slamming the whole account short the market here, and you're gonna diamond hand it down to fucking 435 or something like that. You're just trying to capture some of that volatility into Wednesday. Hey, Trader Podcast, we got to talk about that too, man. I gotta give you like a special area for that too, man. We gotta make sure we highlight that for people, for those pivots. Just be conscious. I just saw somebody. Trader Podcast talked about. I think he's been talking about it since this morning. I think early this morning, but the yen dollar short, right? I just saw someone. I just reposted his shit on Twitter, and someone smartly said, "Oh, I'm going to buy the fucking dip on that right now." That person, I don't know who that trader was, but let me see who it was. This trader was, I reposted it. What's his name here? Hoppin' into foreign. HOPINDAFOREING. That guy just was like, yeah, fuck it. You know, like when you see stuff like that, big giant moves, outsized moves like that, that's an opportunity for you to go in, swoop in. And right now is one of these opportunities on SPY and tech. As we approach up here, you can just be like, yeah, I'm just going to throw something in the money on. All we have to do is break back down below, and we have a volatility event coming. On Wednesday, we have some volatility coming to the market, one way or another. So I bet it's a cheap trade. I'm not going to look it up right now, but right around here, these are the two places that you start to consider. This one right here and this bar right above it to put a nice little hedge on. Don't worry too much if we squeeze up. Don't care about that. Just put the trade on, right, and close that laptop with that trade and come back to it on Wednesday. Open it up, and I guarantee it's going to be printing for you. It's an easy trade. You're basically saying to yourself, if we hit 4,600, I know it's going to bounce down, right? That's what you're telling yourself. We hit 4,600, expect a bounce down off of that 4,600. Easy trade. Easy fucking trade. If it gets rejected, you're already in. If it squeezes up, you already know it's coming back. So fucking simple trade. All right, I gotta go. I'm getting back in a call right now.
NYMEX diesel January futures settle at $2.5492 a gallon. And gasoline futures settle at $2.0012 a gallon. US crude oil futures settle at $69.34 a barrel, down 4 cents or 0.06%. Excuse me, that's down 0.06%.
Watch that roll coming down right now. I'm going to be trying to get some puts here. So if you're going to be grabbing some puts, if I buy any, I'll let you guys know. Okay, give me just 1 second here. I'm just waiting on the confirmation rejection candle. No confirmation yet. Just watching for a rejection candle here. If we get the rejection candle, I'm going to buy some puts. All right, guys, just a heads up here, right? I should not be doing this, so do not follow me on this, okay? Do not follow me on this. I'm about to load the fuck up on puts here, and only because they're pennies. You're probably going to lose all your money in this trade, so don't take it. We're likely going up. But I am going to load up here on 457 Ps. They're 6 and 7 cents right now. I don't care. I don't give a fuck that I don't care if they burn, but you shouldn't follow me on this trade. It's just it'd probably print like 5,000%. So that's the only reason I'm going to grab them up here. I'm going to grab them on this, that red bar on Bookmap up there. I'm going to try to grab them right up on that red bar for a rejection if we can get it.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%. 10 minutes away from the top of the hour, we get the US consumer credit forecast 8.5 billion, prior 9.06 billion.
I got them for today, man. I don't think we're going to roll down there. They're too cheap. I think that we're going up, but it's just so cheap that I got to do it. You shouldn't be asking me how long I'm going to hold these things for. Zero dates are directional. If you don't know that, you probably shouldn't be trading them. They are literally, they have zero intrinsic value. Zero. They're good for one thing and one thing only. A single direction. The moment that direction ends, they go back to zero in value. If you don't understand that, you should get in our Discord. I don't recommend anyone trading zero dates if you don't understand that concept at all, ever. It's very dangerous.
It's a little different this
not
year
understanding
than
the
in
mechanics
lists
of
past.
that.
Julia Borston is here to explain.
Well, Kelly, right now it's a rough market for startups. The third quarter saw the lowest overall venture deal value in 6 years and the lowest number of deals in 3 years, with U.S. VC funding this year on pace to set a 9-year low. Plus, companies that are managing to raise funds increasingly are doing so at lower valuations. The number of down rounds in the third quarter climbed to a 10-year high, with 26.4% of rounds completed year to date done at a flat or reduced valuation. Now, lack of access to capital means more companies are going out of business. Carta reported that 87 of the startups on its platform that had raised at least $10 million had shut down this year as of October. That's twice the number of companies that shut down in that same category for all of last year. And now, after only 27 companies went public in the third quarter, there is a pileup of companies waiting to go public, 75 according to PitchBook, including some big names such as Stripe and Chime. And as we look ahead to our next list, it's worth pointing out that our first 11 lists have identified some outperformers. Our Disruptor 50 index, companies that have gone public from our Disruptor 50 list, is up 28% year to date versus the S&P 500's 19% gains. So now we are looking for private company nominations for the 12th annual Disruptor 50 list, which will debut in the spring. To learn more, scan that QR code on your screen or go to cnbc.com/disruptors.
What is the classic description of a disruptor for this contest or competition?
Well, what I have to say is when I founded this list 12 years ago, the idea was to look at how technology is disrupting every single industry. So what we see every year is companies not just in sort of stereotypical tech industries. Yes, we have a lot of AI. OpenAI was the #1 company on the list last year. But we also see companies in the ag tech space, in logistics, even in retail. So there are all sorts of different ways people are using technology to disrupt their respective industries. The companies do have to be private. They're usually venture-backed. And the idea is to find the fastest growing and most disruptive companies. So really ones that are prompting change in their industries.
And you said the number of deals are down, the number of companies that are going public are down. What do rising and the number of bankruptcies are up? What do rising interest rates have to do with all that?
They have a lot to do with it. I was actually talking with my colleague Bertha Coombs about the biotech space, because two areas which have remained relatively resilient relative to some other categories are AI.
based companies, no surprise, but also biotech in the life sciences field. And she was saying that rising interest rates have hurt that category because those are so cost intensive. Those types of companies are so cost intensive. You're not just launching an app. And we have seen that negative impact throughout the space. But also remember, we had that Silicon Valley Bank implosion this year. So that has had an impact as well. And overall concerns about the economy. So there have been so many different factors that have put pressure on this market. But a lot of investors have said this is a great time to get in because valuations have come down.
All right, Julia, great to have you in the house.
It's great to be here.
Appreciate it.
Excited to see who's
All
on
right,
it this
so
year.
many headlines to get to, so little time left. We will power through as many as we can in closing time. Power Lunch is back in 2.
5 minutes from the top of the hour, where we get U.S. consumer credit forecast 8.5 billion, prior 9.06 billion.
Come on, make him burr, baby, make him burr.
So a reminder, earlier on, he did have news that AMD stocks rose after its AI chip rollout challenges NVIDIA. So a reminder, that news did come out yesterday.
I'm still long those puts right now.
Welcome back, everybody. 2.5 minutes in the show and several good stories to talk about today. Starting with Moody's reportedly advising staff at its
Just
Chinese
give me a
offices
20-minute
to work
fucking
from
rug
home
pull,
ahead of its cut
please.
to the outlook for the nation's credit rating. Employee sources told the Financial Times the move was prompted by fears the Beijing regime could somehow retaliate. Moody's lowered its outlook for China's rating to negative from stable on Tuesday.
There haven't been any repercussions that we know of just yet. They haven't shut down offices. They haven't targeted employees.
No.
But it tells you a lot about about what it's like to do business and
tells
live
you a lot,
in China. All right, the labor picture isn't quite as rosy in the Garden State, right here. New Jersey's unemployment rate rising faster than any other states, and yet there aren't enough able or willing folks to fill the jobs that are actually available. It's that there are, I guess, sort of people just don't want to take the jobs that are out there, not qualified for the jobs that are out there, so they're sitting on the sidelines, unemployment going higher.
Maybe it's just a quirk and things will kind of level back out, but this is uncomfortable territory to find ourselves. We're also getting more details on what might have gone down at OpenAI before Sam Altman's surprise firing last month. In a new interview with the Wall Street Journal, former board member Helen Toner says they fired Altman to strengthen OpenAI and make it more able to achieve its mission. The Journal reporting a critical paper she wrote in October may have angered Sam, causing tension between the two.
And apparently there was a lot of behind-the-back back conversations that were going on in this very small board of 4 people. And I gather that some of the people who had these behind the back conversations felt as though Altman was not accurately representing what they had said.
Right.
Hence the break in, quote, trust that has been described here.
Indeed. And so they still have to figure out the board situation, the company structure, and all the rest of it.
On to GameStop, granting Chairman and CEO Ryan Cohen even more access to the remote control, including the ability to use company cash to buy other stocks. Company cash can now be used to buy equities instead of just short-term debt, and Cohen is also in charge of the investments. Wedbush's Michael Pachter called this decision inane and inane and alarming.
And $600 million for John Rahm. That's what they're saying, to join the Live Tour.
To join the Live Tour, and he may do it. I thought they were going making peace and going to go putt around, but I guess not. All right, we got to run. Thanks for watching Power Lunch.
Closing Bell starts right now.
Kelly, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 right here at the New York Stock Exchange. This make or break hour begins with tech on a tear today. That sector surging back after a bit of a breather. We'll ask major market bull Tom Lee how far it can run in 2024. He's going to join us in just a few minutes. Also going to reveal his target for the S&P in the year ahead. In the meantime, take a look at your scorecard with 60 minutes to go in regulation. All about the NASDAQ today, but it's green across the board. AI players dominating today. Alphabet and AMD leading the way with the big gains there. Take a look at that. AMD near 10%. Alphabet up 5.5%. That is the largest percentage jump since July for that stock. Broadcom bouncing too. That company getting set to report earnings in overtime tonight. Shares on a massive run this year as well, about 65%. Well, it's been another rough day for energy. That sector is sinking yet again. Take a look at the chart. It's been ugly of late. Crude getting back to $70 momentarily, and that's before a midday reversal. There you see it. A little bit of a rally back, not much. Does take us to our talk of the tape. The year ahead for your money, as some bulls suggest, this market can keep running well into 2024. One of those optimists, an uber one at that, is Tom Lee. He's FundStrat's managing partner, head of research, back with us at Post 9. Welcome back.
Great to be back, Scott.
All right, so before we get to where you think we can go, you were pretty right as to where you thought we would be, right? 47.50 was your target for the end of this year. We're at 46, we'll call it. You said mega cap was going to lead the way. In fact, it has. Why do you think things have gone right for you and investors and bulls for the most part, especially lately?
I think people were fooled by the yield curve at the start of this year, thinking we'd have a hard landing, and they didn't want to fight a Fed, but they're forgetting the Fed was fighting an inflation war, not a business cycle. So our bet was inflation would be softer, you'd avoid a hard landing, and then we've seen the Fed kind of take its foot off the neck of monetary policy. So I think it was economists were too bearish, and the technical picture turned positive very quickly. It was a triumph of technicians.
Yeah, it's not over yet, right?
No.
And there are those who still say that the cycle's going to end because of what the Fed has already done. We just haven't seen it yet. You've heard that. How do you respond to that?
I think people should study market internal structure. We've seen a huge turnaround in cyclical stocks. The banks are turning, the regional banks are turning up, small caps are leading. This is not end of cycle market behavior. This is early cycle expansion reaccelerating.
What if it's just a late year, run as fast as you can, catch up to what you missed, a lot of money has come in and it's just chasing everything to the end of the year as rates have come down?
Well, if we thought this was a head fake, and I think if this is 98, we can run another 7% from today.
To when?
To year end. But
this year end?
Well, I think 4,800 is more reasonable, but I think that if it was a head fake, we'd see credit calling baloney, and we'd see spreads widen or high yield falling. But what's happened is spreads have rallied, high yields rallied. It's actually a improving liquidity rally, while investors took $240 billion out of stocks this year.
So you're a believer in the broadening of the move, and you think it carries beyond the calendar turn?
Yeah, because now as we get into next year, we'll have an FOMC decision, but I think it's going to show the Fed is no longer fighting an inflation war, but really shifting towards managing the business cycle. Huge change. I think interest rates could make a huge move lower. Mark Newton, our technician, thinks it could be 3.5%, 3.2%. And that would take mortgage rates down to 5 or under 5%, we know that would help the economy, and I think there's a lot of pent-up demand for CapEx. So I'd say that stocks could do very well next year.
Well, you must if you think we're going to get to your target for 2024 S&P is 5,200.
Yes.
What gets us there?
Well, it's earnings recovery. So we think earnings hit 265 by 2025. That's 2 years of like 9% growth. And you put a 20 PE. A 20 PE has happened 50% of the time when the 10 years between 4 and 5%. So it's the most common PE to apply, and that would be 5,200. But I think that's conservative because 265 is 5% of it's coming from cash, right? So there's like 3% organic growth. I mean, cash earnings is 5% growth right now per year.
I hear bears say earnings aren't going to be as good because inflation is not going to be as good for earnings. And that's going to be a negative, and that's why the market's overvalued, and people like you at $260 are just way too optimistic on where earnings are going to be.
Well, I think people should study the PPI. Like 4 or 5 sectors are correlated to PPI, like materials, energy, meaning as inflation falls, they make less money, but tech and industrials have almost no correlation to inflation. And then financials are positively correlated. So I think you have more groups that could actually have better earnings power into next year, and especially if caution comes off companies. You know, CapEx, there's a lot of pent-up demand in CapEx. 5 out of 10 groups actually sort of cut CapEx as a percentage of revenues last year. So you have a CapEx opportunity, you have a home recovery opportunity, and you have interest rates falling. It's hard to say stocks should fall next year.
So the market thinks the Fed's going to cut first in March, 3 meetings from now. Is that what you think?
I mean, to me, that intuitively seems aggressive, but what's going to matter more is what the bond market starts to price. And I think the two-year is telling us the Fed does have to cut meaningfully next year, because if they don't cut and inflation weakens, the level of real Fed funds is associated with a hard landing. Like the Fed, if they're trying to manage the business cycle, would be cutting rates.
Yeah, but you think it could be a little aggressive in terms of March. Do you need the Fed to be somewhat aggressive in cutting to get to your 5,200?
We just need the market to get comfortable with 2 things: that the curve can stay inverted, meaning the 10-year could actually go to 2.5 and the Fed's still at 4. And the second is that stocks and bonds don't have to be positively correlated. So yields could go up and stocks could rise. So I think that there's some protection or buffer against if the Fed doesn't cut rates.
How much do you need cash to come in from money markets that's been sitting in safety, and now it goes towards risk assets because rates have come down and you get better yield out of the equity market?
Yeah, I mean, Scott, this year if someone bought FANG, they'd be up 85%. That's 15 years of money market cash. If they buy small caps next year and small caps are at 50, that's 10 years. So I do think the $240 billion that left is coming back in. But hedge funds also have very light positioning in equities. I mean, I don't know if you saw that there's almost a 5-year low in hedge fund positioning in financials, and financials really should be where things turn next year.
You think financials are going to be one of the leaderships? What about small caps? Because that's where a lot of the conversation has been of late, this awakening that the Russell has had.
Yes.
There's still a lot of non-believers.
Yes. I think there's the callus in place. We've had 12 years of underperformance. The price to book of small caps to the large caps is exactly where it was in '99, which was the start of a 12-year bull run. Banks are a huge weight in small caps. We know falling rates helps asset quality, so regional banks should rally. That should pull up small caps. It's clearly under-owned, and they benefit from inflows. And then, of course, I think large cap banks are really good plays on a CapEx cycle. So to me, it's easy to see the 20-30% kind of moves in those groups. I mean, small caps maybe 50. Whereas it's harder to say FANG can do 50 next year.
The other big call that you're making today, despite revealing your target at 5,200, is suggesting that mega caps, tech, not going to lead next year.
That's right.
Why?
It's that I think the earnings growth they produce doesn't look as special if the PMIs are turning up. If the ISM turns up, S&P earnings are going to grow, 15, 20%. And then in terms of multiple expansion, I think people are going to be more willing to fade a FANG multiple expansion, whereas they'll buy a financials multiple expansion.
So I want to be clear. So you think there's going to be a rotation out of mega cap into some of these quote unquote unloved areas?
Yes. I mean, FANG is still a number 3 pick, which means it outperforms. But if someone's saying, where will they get the best risk reward? I think it's clearly financials or industrials.
When you say that FANG still outperforms, the word you use, put some context to that. What does that mean?
Well, let's say S&P's up 12 to 15 next year. FANG will be maybe a little bit better, whereas financials probably can be up 30, and industrials can be up 25, and small caps can be up 50.
So we're going to really have that significant of a mean reversion trade, so to speak.
Yeah, I think it's consistent. If you look at like the history of a stock like Amazon, they have great, a step-up year, and then they consolidate.
Wow. Let's expand the conversation. Bring in CNBC contributor Joe Terranova of Virtus and Ayako Yoshioka of Wealth Enhancement Group. It's great to have everybody with us. Aya, I go to you first. Does Tom Lee make a lot of sense or not?
Hi. Yes, absolutely. 2023 has really been defined by a very narrow market. And so it makes a lot of sense that going into 2024, that we would see a broadening out of the market, especially if the economic data comes in, relatively benign, neither too hot or too cold.
So you do think we're going to have a broadening? You agree with Tom that we're going to have these lagging sectors are going to be the leaders, that tech can still do well, it just doesn't have to carry all of the weight like it did this year?
Absolutely. I mean, I think if the economy continues to stay relatively strong, some of the, names in the lower half of the S&P 500 have a lot of room to, have the multiple expansion, as well as perhaps some upside surprises to their earnings growth as people start to anticipate a recovery from the slowdown in 2025.
Joe, is Tom too optimistic or not?
Well, first of all, Tom's been incredibly accurate so far in 2023, so congratulations for that. I run an equally weighted strategy, so I'm excited to hear your comments for 2024 because that obviously means the strategy is going to be favored. But there's 3 points I think we need to hit on. First of all, when you look at the market right now and you talk to advisors who have clients sitting in cash, the first thing that they will tell you is they expect the economy to slow, and the cash that Scott cites going into risk assets, those risk assets aren't equities. They want to put those assets into credit because they believe they're also going to get price appreciation. How would you respond to that?
I'm a fan of bonds. High yield returns 80% of stocks with less volatility. But we know that if bonds rally next year, that actually has an expansionary effect on PE. So to the extent people decide to allocate to bonds and spreads have a huge rally, it actually means there's upside to the S&P just because the multiple now has more room to expand.
So Joe, so Tom says 20 times earnings makes sense. Earnings at 260 makes sense. Is that too aggressive or not?
He's too aggressive with financials. I'm worried about financials. Let me explain why.
What about the overall? Give me the view. He says 5,200 on the S&P. Follow me. Stay with me.
No, I'm staying with you, Scott. You know me a long time. I don't do S&P price targets. I do the environment. I've never sat here and said, okay, we're going to 5,200.
Okay. All right.
The environment is a favorable one.
Let me rephrase it into a
invest.
way that we can agree to have a conversation about this. Is the environment going to be optimistic enough?
Absolutely.
That the S&P can get to 5,200?
I don't know the answer to that. I don't think anyone knows the answer to that. I'm sorry, Tom. I don't think anyone knows.
Can we have double-digit returns next year?
Yes, absolutely, you can.
Okay. Aya, what about you? What do you think?
I think we could have double-digit returns too, but I think the setup is very different going into 2024 than what we had in 2022. We had a lot of upside surprises this year in 2023, and I think we could have some jolts depending upon how the data really pans out and how earnings really pan out in 2024.
Well, I mean, for earnings to get to $260, things have to go really right, don't they? I mean, how perfect, I hate to use that word, but in some sense, things need to be perfect. That inflation needs to come down to target. The Fed definitively needs to be done, if not cutting. The business cycle needs to keep humming. The labor market needs to remain robust so that consumers don't stop spending. Can all of those things mesh and make this a perfect, in quotes, scenario?
I mean, never say never, but at the same time, it does create difficulties for 2024. I think you're going to get bouts of it, and it's not going to be a straight path to those potential double-digit returns in 2024. I think the first half could be a little bit more murky as everybody anticipates these rate cuts, and if we don't get them and the economic data, it really does slow, and perhaps more so than everybody anticipates, then that bad news can really create some havoc in markets.
Tom, how would you assess how I've described what needs to happen for you to be right? Am I overstating it? Or do things really need to be perfect for you to get to 5,200?
I mean, here's some simple.
If you're in
math to
puts
think about.
like me, there
Earnings
should
this
be a
year,
reversal back to
so
the
we say 2
downside
years,
to
265
unfuck
for
yourself.
$40.
I don't care if my puts
15
get
is gonna
torched
come
here,
from just
so I'm still holding them,
interest on the
but just be
cash.
careful here.
So it's,
if you're going to get squeezed out of your puts, look
25
for a red
from
reversal
organic
candle
growth,
that'll
which is 10%
be able
over
to
2
take you
years.
out of the trade.
It's basically GDP of 3%, real. I think that's pretty doable. So unless we have a recession, 265 is actually a low number. It could be 275, 280.
Wow.
For 2025.
In earnings.
In earnings, because remember, buybacks is another 5. I mean, just buybacks and cash is 10% a year.
275, 280 will make you like I mean, you're so high up, we can barely see you. We need a telescope to see your number on earnings relative to where everybody else on the street is. I haven't heard anybody suggest, gosh, you could get high as 280.
I mean, just keep in mind, this year, healthcare earnings are down 20%. They won't be down 20% for 2 more years. And basic materials and energy are down like 40, and staples are down. So we could, as those turn, those contribute to S&P earnings meaningfully, especially energy, right? Energy was such a huge swing factor. It's been absent for this year.
Why is it going to be better next year?
Well, if let's say the price stabilizes, so you just look off the curve, they won't be dragging earnings. You'll actually have a positive contribution because they're not declining. So it's not hard to get to 265, actually. Sounds strange, but that's 2 years from now.
All right. Aya, financials, energy, do you like either in 2024?
We like energy. I think the setup for energy still remains very favorable. You know, valuations still aren't at, extremes. I think, you've had some big announcements, in the industry that are consolidating. And, you have earnings growth. And if the economy really doesn't slow that much, if we get that mild recession or the, soft landing scenario, energy should continue to do well as we go into 2025 and beyond.
Joe, you wanted to take on Tom about his financials call. Why?
Financials and energy. First of all, with energy, what if the price doesn't go lower? It keeps, right? What if the price doesn't go higher? The price goes lower. You get a massive liquidation. Everyone is overweight energy. Tom, you know that. In addition, on financials, where's the earnings growth come from? Because if you think about it, you lose the effect of interest income. Interest income was up 22% in 2022, is up 18% in 23. It's actually going to decline next year. JP Morgan and Citi told us yesterday at the Goldman Sachs conference that trading revenue's down. You've got all CEOs complaining about regulation in Basel III. What does that leave you with? Deal making?
Yeah, well, a couple things. One, what you've described is why no one owns financials, right? Because that's why hedge funds have the lowest long positions in 5 years. Second, as George Boyd, head of Kidder Research, famously says, it takes a whole lot of E to offset PE. The financials trade next year is about price to book or price to earnings, which means it doesn't matter what earnings do next year. It's how earnings power is transforming. And look, if we have lower interest rates, we know that this saves commercial real estate. It revives housing. I don't think any investor says, oh, well, your Q2 numbers aren't going to be great. They're going to say this is a switch in how we look at earnings power for the next couple of years. So I think financials have huge multiple expansion potential. And then trading, as you know, trading is spontaneous. It's weak this quarter. It could be huge next year. I mean, $240 billion taken out, gross exposure's low. I'm not surprised there hasn't been much trading. It's going to pick up a lot next year.
But in that scenario, you have to have a soft landing the way you're describing it.
I hope we don't have a landing. Yes.
I don't think Tom's suggesting anything other than that, if not no landing, right? I mean, if you think we can 270, 280 on earnings, well, we can't even come close to a soft landing. That better be a no landing, no late cycle, reacceleration of the economy for all the factors that you suggested.
Yeah, Scott. And one thing I think people have lost perspective on is when the Fed went on their tightening campaign and brought rates in the U.S. above any other developed world, we already had a hard landing in Europe and China. So the U.S. avoided a hard landing because what broke was outside the U.S. If you think those economies worsen next year, then we're in trouble. But if they're turning around and the DAX is telling you things are turning around in Europe, you don't need a landing in the U.S. because we had a landing elsewhere.
Aya, I give you the last word.
No, I think Tom always makes some great points about the market outlook, and betting against Tom has not been favorable, I think, to many investors. So I would go and listen to what Tom has to say.
All right. Aya, thank you. Tom, of course, thank you as well. Joe, we'll see you in the market zone because we have a little Broadcom to talk about before those earnings hit. Let's get a check on some top stocks to watch as we head into the close. Pippa Stevens is here with that. Hi, Pippa.
Hey, Scott. Dish Network and EchoStar are in positive territory after the FCC approved their merger. Despite the agency's scrutiny on other big mergers, this deal was given the green light because billionaire Charlie Ergen is already the controlling shareholder of both companies. Those stocks up roughly 8%. And Domino's Pizza is at its highest level in over a year as the pizza giant lays out its targets during its Investor Day. Executives are aiming for annual same-store sales growth of 3% through 2028 and say they're looking to add new menu items and rethink existing items. Those shares up 2%. Scott?
All right, Pippa, thank you. We're just getting started here on Closing Bell. Up next, Alphabet shares, they are surging today. Investors are cheering the arrival of the company's AI model. We're going to hear from CIC Wealth's Malcolm Etheridge. A lot of skin in that trade. You know that. We'll find out how he's playing this announcement. Does he like Alphabet now? We'll find out after the break. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC.
So we have posted out on the newsfeed the FX option expiries for Friday. Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Well, the AI arms race is heating up, that's for sure. Alphabet shares are surging today after the company announced their AI model Gemini. Microsoft also getting a boost after having their own shareholder meeting earlier today. Let's bring in CNBC contributor Malcolm Etheridge of CIC Wealth to discuss all of this. So I look at Alphabet's having its best percentage day since July. You sold it, and we made a whole big deal about that. So what do you think about this announcement? You write them off too soon?
Yes and no. So yesterday, I got the same announcement everybody else got, and I thought, this is finally their moment. This is what I, as a former shareholder, was asking for, 12 months ago almost, it feels like at least. And this morning, we're getting reporting from the information and others that maybe there's not as much there as we thought, and Gemini is not as powerful as it was initially touted to be. Maybe it's the equivalent of what GPT-3 actually was. And so I'll say let's hold on for a second. Let's wait to see after people get their hands on this Gemini model just how powerful it actually is. But I will say I'm also thankful that Google has finally woken up and joined the party.
Yeah, look, I'm not going to be critical of the fact that you don't own Alphabet. You can't own everything. I think that's fair to say. You own Amazon and Microsoft, of course, Apple, and some other names as it relates to this space. But do you feel like we're going to get, as we turn the calendar into 2024, we're going to get a more distinguishing line between the real winners and those who are pretenders?
100%. I think we're probably turning the corner here where we're probably going to add another 3, I think maybe 4 names to the Magnificent 7, as we've been calling them this year, that are all the names that are actually doing something tangible in the world of AI. And I think the ones that are going to be the dominant leaders of that 10 are the ones that show a way to actually commercialize and generate revenue using those tools sooner than later. So a lot of what we were promised in AI back in March was solely just the promise of this is what AI is going to do. I think we're now going to be a little more critical and say, show me the money.
As I referenced, you obviously have a significant exposure to mega caps, which Tom Lee, who's as bullish as anybody I've heard, suggests that they're not going to lead. They're going to outperform, but the mega caps are not going to lead in 2024. Do you share that view?
Absolutely not. I was shocked to hear Tom say the financials were actually going to be twice as good from an investment return perspective as mega cap tech. I think realistically what is happening is the broader economy is not doing so great right now, but it's being overshadowed by the fact that AI has just captivated our imagination and made us excited about the return potential as investors with these 7 to 10 stocks, as I mentioned. And so I think all of the capital, one way or another, is going to flow into those 10 names in 2024, and that's what's going to end up dominating the S&P and the NASDAQ once again.
Wow, so it's going to be the same thing that happened this year? You must not. Does that mean you're not as sanguine on the economy as others or earnings? So we're going to once again just go balance sheet hunting for safety?
Well, as I said, I think that the broader economy is not doing so great, right? We just got
well, it's not doing so bad. Not doing so bad.
Maybe, but I think that what we're seeing is a dislocation between the stock market, where we should have had a pretty flat stock market this year, not nearly as impressive as it is, except for the fact that AI came in March, thanks to ChatGPT, and stoked everyone's excitement about investing all over again, and it's tech. And so I think we'll add a few names. Maybe we add Adobe, maybe we add Salesforce, maybe we add AMD, names like that have actually shown a immediately commercial ability to generate revenue using these tools, specifically co-pilots that they've adapted. But I don't think that the broader stock market is necessarily in any better shape than it was the last couple of quarters. I think we're just not seeing it because the S&P is getting led by AI once again.
No, but the performance, let's just say since the end of October, if I would have asked you this question then, I would say, okay, yeah, you're right, obviously. However, it is obviously a different story. I'm looking, the Russell's up 8% in the last month. that's not a broadening out. That is far from a top-heavy, more recent market. You could be highly critical, if you want to be, of the internal makeup of whatever the market did up until November, and then it's clearly been a much different and, dare I say, healthier story, no?
I think that's fair to say. I think that the AI high tide raised all the boats. I think what you're making a very good point, that there was a giant gap between the Magnificent Seven and everybody else, and the other stocks decided to gap up instead of the Mag 7 gapping down. But at the same time, I think what's going to continue that narrative is not going to be small caps, it's not going to be financials, it's not going to be energy. Where people's imagination and excitement gets captivated once again come earnings season is going to be AI once again.
I think my point, though, is that it's not AI tide lifts all boats. It was, but this has now morphed into, we're actually going to pull this off tide. That's the soft landing tide is the one that's lifting all boats. As rates have come down, that's why small caps and all of these other areas that did nothing are finally performing well.
Yeah, I'm not a believer in the soft landing. I think what we probably did was just delay the period where we're going to have to take our medicine. It doesn't make sense to me logically that the Fed could raise the cost of short-term borrowing on an economy that's built on consumption and on a consumer that's powered by borrowing, and we're not going to have anything negative happen in the economy as a consequence of that. And so maybe we just pushed it into 2024, where we would have been taking our medicine earlier this year. But I still think that R word, the recession, even if it's a mild recession, is going to show up here at some point early in 2024.
But I mean, we skewed the system going into the rate hikes, did we not, by stimulating the economy to a degree where you and others would probably suggest it was way too much, and that's why we are where we are. That changed the whole paradigm.
I think you're also giving a little bit too much credit to a Fed who got us into this mess in the first place, and assuming that they will also perfectly time the cuts on the other side, right? So we've already heard the higher for longer rhetoric from Jerome Powell and others, and I think they'll continue to hammer that home at the next Fed meeting and the ones that follow. And we're going to assume then that the same folks who brought us transient were the same folks that are going to also perfectly time the cuts and bring us back down on the other side of that mountain. So the ascent has been, I won't say it's been great, but it's definitely gotten us where we needed to be. Now we have to focus on perfectly executing the descent back down the other side of the mountain. And I'm not so confident that the Fed will land that plane so perfectly.
We'll make that the last word. Malcolm, appreciate it as always. Thank you, Malcolm Etheridge. Joining us here on Closing Bell. Up next, betting on an IPO bounce back. Star VC investor Rick Heitzman's back with us today. Breaks down his forecast for the market as we make the turn into 2024. We'll see if we are more open for business in a new year. Closing Bell's right back.
Just
the
head,
market
just
and closing imbalance
hold on,
still
let's see.
sitting at
Just head,
5.5 million to the buy side.
just heads up here that I'm using TradingView on multiple platforms right now, and they're having downage right now. Trouble. They're having trouble on the
$99 a year for
TradingView site.
real-time service.
Stevens is standing by for us today again with that. Pippa?
Hey, Scott. Well, one airline stock is taking off on an improved forecast while an AI darling pulls back on disappointing results. We'll bring you those names after the break.
We're about 15 from the close. Let's get back to Pippa Stevens now for a look at the key stocks that she's watching. Hey, Pippa.
Hey, Scott. JetBlue is having its best day in 3 years after raising its fourth quarter and full year guidance. The airline says bookings have exceeded expectations for both holiday and non-holiday travel periods since late October. That has shares up roughly 15% heading into the close. And C3 AI is having a rough session as a revenue miss overshadows a narrower than expected loss per share. The AI giant also issued disappointing third quarter and full year guidance. But despite today's pullback, the stock is still up over 130% so far this year. Scott?
All right, Pippa, talking about AI yet again. Pippa Stevens joining us there. Still to come, breaking down Broadcom. That's semiconductor giant AI Play 2 reporting at the top of the hour. We're going to hear from shareholder Joe Terranova with what he'll be watching when those numbers hit. Closing bell right back.
NBC.
Up next, Lululemon reporting results in overtime. It's seen some serious gains this year, at more than 40%. We'll give you a rundown of what to watch for when those numbers hit the tape just after this break, when we take you inside the market zone.
Our company was founded 33 years ago in Cambridge to develop a device that was intended to run off of a battery. If those folks could see today that we are in electric vehicles, the cloud data center, AI devices, it was quite an amazing journey for our company. I could not be more proud of what we have achieved in the last number of years leading up to this historic day.
and take a look at the market and closing balance. Currently sitting at 245 million to the buy side. Still waiting for the final orders.
I prepare like no one else, so you can be prepared for any market.
It's giving me a sense of empowerment.
Experience why I love teaching members in the club.
Join the CNBC Investing Club with Jim Cramer. Go to cnbc.com/become a member.
We planned well for retirement, but I wish we had more cash.
You think those two have any idea that they can sell their life insurance policy for cash, so they're basically sitting on a gold mine? I don't think they have a clue. That's crazy. Well, not everyone knows Coventry has helped thousands of people sell their policies for cash, even term policies. I can't believe they're just sitting up there. Sitting on all this cash.
If you own a life insurance policy of $100,000 or more, you can sell all or part of it to Coventry, even a term policy, for cash or a combination of cash and coverage with no future premiums.
Someone needs to tell them that they're sitting on a gold mine and you have no idea. Hey guys, you're sitting on a gold mine. Come on,
Do you hear that?
I don't hear anything anymore.
Find out if you're sitting on a gold mine. Call Coventry Direct today at 800-571-7900 or visit coventrydirect.com.
Hey, can't stay here.
Good morning with Vocalax.
Good morning.
Yeah. Try Vocalax Chewy Fruit Bites for fast and gentle constipation relief in as little as 30 minutes, making your good morning even better with Vocalax.
Power E-Trade's easy-to-use tools like dynamic charting and risk-reward analysis help make trading feel effortless. And its customizable scans with social sentiment help you find and unlock opportunities in the market. E-Trade from Morgan Stanley. With powerful, easy-to-use tools, Power E-Trade makes complex trading easier. React to fast-moving markets with dynamic charting and a futures ladder that lets you place, flatten, or reverse orders so you won't miss an opportunity. E-Trade from Morgan Stanley.
The Market Zone is sponsored by E-Trade from Morgan Stanley. Trade commission free today with no account minimums.
All right, we're in the closing bell market zone now. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Kate Rooney looking ahead to Lululemon earnings. They're out in overtime. And Lulu and Broadcom shareholder Joe Terranova is back to share what he expects out of both of those reports in OT. First, though, Mike Santoli. See Tom Lee?
Yeah.
Tom Lee says, hey, could get to 4,800 before the end of this year, 5,200 by the end of next. And he threw out some pretty stratospheric earnings predictions as well.
4,800 by the end of this year would be, it's interesting, we were exactly at this point 2 years ago, and what you got was 4,800 by the end of that year, as he said. So it maps to that, and it was sort of on nothing if you think back to it. It wasn't as if you got some great reassurance on where inflation was going or any of that in 2021. So you can't rule anything out, obviously. I think mostly what the market seems is pretty relaxed about the general backdrop, and then going into payrolls tomorrow. The last two jobs Fridays, market was up 1% each day, just about 0.9%, 1.1% last 2 months. So I think there's a sense out there that the accumulating evidence of moderating but not falling apart growth is good enough that even if you get a wild card tomorrow, maybe it doesn't knock it too far off course. Now, in terms of the earnings outlook for next year, I'm all for the idea that you can make the numbers for double-digit growth. There's some very specific ways you get there. Pharma, massive drops this year, can come back. Then you got the big six of the NASDAQ that are just going to grow off huge bases. The other piece of it is every bank is expected to have down earnings next year. I mean, something could happen that maybe they can be flat and not down. So I don't know about getting $15 a share for the S&P 500 earnings off of just interest on the cash, as Tom said. I mean, I don't think that math works, but maybe it does.
No, I mean, look, 260 sounded optimistic. Then he wanted to outdo himself when he threw out the even bigger numbers. Speaking of numbers, we get some from Lulu, Kate Rooney, and OT. What do we expect?
We do, Scott. So Lululemon coming up here. We're going to get another read on the consumer when Lululemon reports after the bell today. Wall Street's watching international sales. China's been a big growth area for Lululemon. And then same-store sales in North America. And then any commentary around consumer and holiday sales recently, which could affect guidance going forward. Analysts are anticipating 14% earnings growth and then 18% revenue growth. Stocks up more than 40% this year. It's up 20% or so since getting added to the S&P in October. Lulu did see a couple of analyst downgrades today ahead of that report. Raymond James citing the rally, saying that price gains, they're already factored in at this point. And then Wells Fargo saying that confidence in the stock has played out still. Got about 70% of analysts right now with a buy rating on that stock.
All right,
Scott,
we'll see you in OT when the report hits. Kate Rooney, thank you so much. All right, so Joe Terranova's here. Let's take Lulu first.
Okay.
Been in that stock and a believer for a long time.
Quite some time.
So what do we think?
So listen, you should expect strong profitability. You should expect strong sales. I think two numbers to look at. Direct to consumer, does that grow above 15%? Gross margins, can you sustain above 57%? And is the growth in international present once again? I also think the guidance on revenue is important. Let's keep in mind they'll do about $2.2 billion in the current quarter. They're going to look to do $3.2 billion in the upcoming quarter.
Does the stock, I mean, it's a lot to live up to. The stock's up better than 12% in a month. I've got a lot of things on my screen here, and AMD's up 13 in a month, but nothing else pops like this one on my screen here.
No, I think the November 2021 price at $485, which is the all-time high, seems to be where the gravitation wants to be. The options are pricing in a 5% move over the last 8 quarters. The mean move is about 8%. So it's a little less volatility, which is somewhat surprising. But this is a stock that's outperformed the consumer environment with so much friction.
You know what, Mike, also in the last, I want to say 10 days, you've had a couple of different notes. One of them was, the US 1 list. Hey, we're putting Nike on. We're taking Lulu off. And then there was another note with very similar calls.
Yeah, people are looking for laggards, I think. So you either have, the commitment that the market is able to reward winners and they're going to keep going. That's the Lulu story. That's like the Chipotle story, where you have big secular growers. They still have a ton of room for store expansion and everything else. And they have this demographic sweet spot and pricing power, all that stuff. And if you want to make the bet that that's largely in the stock and maybe the other quality names in the group can come around, that's where you get the Nike story. Nike's like flat for the year.
All right, Joe, Broadcom was a $1,000 stock. That's the 52-week high. It's been working its way back, and it hasn't gotten the headlines that the NVIDIAs or the AMDs or some of these other AI plays have gotten, but those who know, and they've been trying to tell that story.
Oh, for sure, and this has been we call it the valuation alternative to a more expensive NVIDIA. I will tell you, this is an interesting report tonight because you're going to need AI to save the day, because there's a little bit of embedded weakness. When you look at wireless, Apple units are going to begin to decelerate. So you need AI to really step forward here. In addition to that, it's infrastructure software, which is now inclusive of VMware. That's 43% of the business overall. But I'll tell you what my position's got on some strength. I think I'm going to do what a lot of money managers did in NVIDIA, and that's probably pare back the position a little bit. Look, we look into 2024. What do we see? Sell the winners, right? Mike calls them the crowded. Sell a little bit of the crowded, buy the neglected. I think Broadcom might be a little bit of evidence of exactly that. You might get a little bit of similar NVIDIA reaction.
Yeah, what do you think, Mike, about Broadcom? It's been a great stock.
It has been a great stock. I think people feel comfortable with it because you do have a decent valuation cushion underneath you. It's not one of these all or nothing, really earnings momentum stories. But historically, the market doesn't love having to play a secular theme with a small subcomponent of a company. Now, look, arguably, IBM is benefiting from a little bit of this halo too, where you have a good cash flow story alongside this idea that they can be in the orbit of AI beneficiaries. So, we'll see on that front. All semis working today, by the way, on the back of that AMD news.
All right, Joe, I appreciate you sticking around. Thank you. That's Joe Terranova. Mike, we got a minute left. Let's set the scene here for the morning. Jobs report, 8:30. Yields have steadily been coming down. Yeah, they stabilized a little bit today, but you're still looking at a 10-year as we speak at 4.14. Do we get a greater move towards 4%? That's going to be really fun to watch.
It will, and I think it would probably have to happen on the wage growth side for that to soften up a lot, because the long end, in theory, shouldn't necessarily be the main thing moving according to Fed expectations. Maybe the 2-year yield comes down a little bit more if all of a sudden it seems like the job market is wobbly. I think if we get an on-consensus type number for job growth, it's still healthy growth, 150 to 200,000, that to me doesn't mean the Fed's got to get a lot more dovish than we think today.
That'll just play right into the soft landing hands. All right. right, Mike, thank you. I'll see you tomorrow. I'll see all of you as well. Look forward to that. Dow's going to go out plus 61 into OT with Morgan and John.
Stocks closing higher, led by tech, with the S&P and Dow snapping three-day losing streaks. That is the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Fort.
On today's show, a nice variety of earnings in chips, retail, software. We're going to hear from Broadcom, Lululemon, DocuSign, RH, and more.
Plus, former Fed Vice Chairman Richard Clarida joins us ahead of tomorrow's key jobs report and next week's final Fed decision of the year. Also CPI.
Yeah, that too. To the market action for now. Mostly higher session after a string of losses this week. Yields and oil were subdued today, but look at the action in tech. The NASDAQ led the gains. AMD and Alphabet, that's of course Google's parent, seen sizable jumps on AI announcements. And joining us now is Peter Cicchini of Excited Capital and Ed Clissold of Ned Davis Research. Good afternoon, guys. And after bumping around sideways to down, the S&P is about back where we started the week. So since you expect choppiness for about the next half year, should investors buy beaten up defensives here?
Special offer of Financial Use Pro for
I think as we get closer to year end, that could be the case. We probably have a few more weeks of window dressing, of selling for tax loss purposes. So maybe the momentum trade can work for a little while longer. But as we move into 2024, you can get that January effect where the last year's losers gain momentum again. But more importantly, we could just get a choppier market overall. First half of election years tend to be weak. We expect the economy to slow. We don't think there's necessarily going to be a recession, but the recession calls are still going to be around. So you get some slow economic growth, some fears of recession, election uncertainty. That's a choppy market. And so some of the defensive areas which have lagged so much this year could actually have a little bit of mean reversion.
And Peter, I think you see some of those dark clouds gathering. You say a soft landing is highly unlikely. Lori Calvasina told us yesterday she likes small caps and then equities. You seem to be taking the other side, looking at bonds here. Which ones?
The December 19th decision.
Yeah, it's interesting when we think about what the market's been doing of late, especially into the end of the year, and I think about Decembers. I think it's something like 39 out of the past 53 Decembers have been positive. I don't think that really tells us much, given the window dressing it points to and seasonal factors, about what's going to happen next year. I think, look, small caps were potentially interesting a month ago. They've rallied quite a bit. I think the problem with small caps here, given our slowdown recession view, is that they are subject to financing needs in a much higher rate environment. And that's one of the reasons why they haven't come back as they have, as they often would into the end of the year. So I think when we look at small caps, when we look at high yield bonds, for example, spreads are 400 on CDX high yield. With the VIX at 13, last time that happened, CDX high yield was at 300. So small caps, CDX high yield, telling you that storm clouds are on the horizon. Our view for next year is that as would be normal after a series of hikes as aggressive as what we've seen, that we're going to see a significant slowdown.
Okay, so any sort of sense on what a significant slowdown could actually look like, Peter? And I ask that because we know every economic cycle, every time you do see a recession actually materialize, if that is in fact what happens next year, each one it's its own beast. But does it feel like a certain time period that we've seen in the past? I mean, are you looking to certain historical templates as how this could actually affect the markets and play out?
And it's a great question. And, this time has been somewhat different. And, the long and variable lags and, the Fed tightening have been a bit longer because of the, the knock-on effects of massive pandemic era stimulus and all the unintended consequences, not just inflation, but, all the excess savings and everything else. So sort of calling how the recession is going to look is difficult, but there are maturity walls coming up in commercial real estate, $1 trillion over the next couple of years. High yield maturity walls are also building in 24, 25, and 26. So it could look like a good old fashioned, 2000-ish kind of recession with an element of sort of the 90s credit crunch.
Interesting. Ed, I'm looking at your year-end 2024 price target for the S&P. It's 4,900. Implied upside from here, something like 7%. How do we get here? I would imagine you're not baking recession into your base case with that price target.
That's correct. So slow down the first half of your choppiness, and then as it becomes evident that there isn't going to be a hard landing, then the market can rally toward the back half of next year, and that's where you can get a chunk of those gains. Now, look, the recession is not completely off the table, but if you look at, there's been a few cycles where the Fed has actually pulled this off. In the 2018 cycle, the 95 cycle, and back in 1965, they were able to do it. And I think the Fed's rhetoric change over the past several weeks has been a positive sign from being extremely hawkish to recognizing they've done a lot of work already, and now they can see what the effects are going to be. And it always, with the U.S. economy, comes back to the labor market. We can be adding 150,000 jobs a month. It's just very hard to get a negative GDP number because consumers, 2/3 of the economy.
Okay. Gentlemen, stay with us because we're starting to get our earnings. The first ones are out. Lululemon, I'm going to run through those numbers here. Not immediately clear that adjusted EPS result is comparable with street consensus, so I'll just give that number first. Adjusted EPS of $2.53 per share. Looks like revenues beating here, $2.2 billion versus street estimates of $2.19 billion. Q4 revenue guidance, though, looks a tad light. We're seeing $3.14 to $3.17 billion in revenue for the fourth quarter versus consensus estimates of $3.18 billion. Initiating $1 billion buyback here. A couple other stats for Lululemon that really matter. Total comparable sales increased 13%. Comparable store sales up 9%. Direct-to-consumer net revenue up 18%. And here's another one that matters with retailers in general. Gross margin increased 110 basis points to 57% as well. Nonetheless, with that light Q4 revenue guidance and a stock that was up something like 40%, going into this print, you're seeing shares down about 7% right now.
Sounds, Morgan, like they're determined to hold their pricing levels, not give that up in order to boost revenue. They don't want to do discounting into this holiday season.
It seems like that. And you do have this commentary from CEO Calvin McDonald as well in the release where he says, as we enter the holiday season, we are pleased with our early performance and are well positioned to deliver for our guests in the fourth quarter. But we'll have to see what additional insights and color we get from the call. And of course, we will be joined by Dana Telsey to break down these results in just a short while as well.
All right. See if they can hold the line on pricing and maintain that revenue. DocuSign earnings, meantime, are out. Pippa Stevens has those. Pippa.
Hey, John, that stock jumping 9% here after the company beat top and bottom line estimates for the third quarter. DocuSign earned 79 cents per share on an adjusted basis. That was 16 cents ahead of estimates. Revenue coming in at $700 million, also ahead of the expected $690 million. The company also giving optimistic Q4 revenue guidance, saying they expect the range to be $696 to $700 million, while analysts were looking for $694 million. The CEO also said that they're making progress on moving beyond e-signature and into intelligent agreement management. Once again, that stock up 9%. Morgan?
All right, I will take it. Pippa, thank you. Peter, I'll go to you on this one because, Ed, I know you don't like to talk individual stocks. Maybe you'll take a gander on one of these, either Lululemon, which seems to be focused on not discounting too much with a broad consumer landscape where the consumer seems to be looking for deals. And then you got DocuSign, which is a pandemic darling. It was trading above $300 a share, just maybe showing that a turnaround is still a possibility.
Do I have to pick one?
You don't, but the consumer writ large is an important theme for Q4. How do you feel about the consumer?
Well, yeah, I'll pivot a little bit to that because I think it's really important. And, we actually spend an awful lot of time pouring through individual company transcripts. And we think it's really a really important way to help us understand how to underwrite consumer risk, which is one of the things that we do here. And to understand what's going to happen, bigger picture macro with the economy. And as you well know, there's been a tremendous amount of caution among CEOs relative to the consumer in the last earnings season. Lululemon, my wife loves it. What else can I tell you? I know we're going to keep buying it. So I guess I'll take the punt and I'll take Lululemon over DocuSign.
Okay. Peter Cicchini and Ed Clissold, thanks for joining us.
I just meant talk about one. I didn't